right. All right, everyone. Testing, testing. Test. Okay. Hi, everyone. I'm MiCA June. This is the investor track of the afternoon session. Hope everybody had their fair share of food and discussions during the break. We have a good lineup of panels for us tonight, this evening. We're going to start it off with crypto, the trade of millennium. Joining us on stage, first we have Chris Perkins. Let's give it up. Let's give it up for him. There's Ryan Silver. Amy Oldenburg. Blue Macholari. And Matt Hogan. Okay, take it away.
All right, you guys want to sit down? Let's just do some brief intros as we get started so people know everyone's background. Matt, do you want to start?
Sure. Matt Hogan. I'm the CIO of Bitwise Asset Management. We're a crypto asset manager, manage about $12 billion in assets. And before Bitwise, I was an ETF guy.
I'm Blue Macholari. I'm head of digital assets at T. Rowe Price. We're a 1.7 trillion asset manager. And before joining T. Rowe, I spent 25 years in emerging markets.
Hi, I'm Amy Oldenburg. I'm at Morgan Stanley on the investment side of the business. I head our global emerging market equity business, and then also am involved in all of our digital asset initiatives, sit on a couple of our working groups there. Like Blue, I've been in emerging markets just for about 25 years, and used to trade EMFX, and one of the ways I ended up in this space.
Hi, everybody. I'm Ryan Silva. I am a partner and head of trading at Borderless Capital. We are a Web3 investment manager. There you go.
Excellent. All right, so Ryan, I'll start with you. These are some of the weirdest markets. I think nobody expected what we've seen. We had an election that everyone noticed, and then we had a president come out and say, hey, we're going to make this country the crypto capital of the planet. You fast forward to today, Bitcoin is 25% down from its all-time high. Nobody expected this. Can you unpack, against these very favorable regulatory, initiatives and outcomes, what's going on in these markets right now?
So, and again, all of these views are my own view, not the view of the firm. That being said, we're at a true inflection point in markets, right? What we're seeing in terms of institutional adoption, the on-ramps into the ETFs, the tokenization that's clearly occurring across chain interoperability, these are all happening real time. There was a little bit of euphoria priced into, crypto and broadly macro assets following the election. That exuberance has kind of forcibly been, delevered and kind of unwound, but it didn't happen in a vacuum. For Bitcoin to move 20 to 25% in a 4-week period is quite normal. For the NASDAQ to move 12 to 13% in the same reference period is actually unusual. So this kind of highlights that Bitcoin and digital assets by extension have been just more institutionalized, and they're becoming more factors of macroeconomics, movements as well in macro markets. So that's a brief summary of what's going on.
So this volatility is pretty profound, and I don't think traditional investors are used to this type of volatility. Like Blue, putting your traditional asset management hat on, is it too early for these types of investors? Like, how do they navigate that challenge?
So yeah, I think we've seen unprecedented volatility across, not unprecedented, but extremely high volatility across all markets. And I think that one of the things is that it's nice to be able to look around and say, well, it's not crypto this time, folks, it's you guys. But I think that at least from my sort of putting my macro hat on, I think that we see a lot of the levers being pulled simultaneously in what seems somewhat familiar from an emerging market sort of structural adjustment perspective. And I think that it's a period of pain that we got through. And I think that we had a lot of great news on the crypto front. We had sort of announcement after announcement. And I think that we tend to be a sector that has a hard time sitting still without constant news coming down the pike. And so we're sort of trading at the mercy of larger macro factors.
So it's pretty interesting. We realized before the panel that both you and Amy have a background in EM. And so it makes sense. You're putting on your EM, I guess, paradigm against these markets, and it's not too crazy. Is that fair, Amy?
Yeah, it feels totally normal. I mean, it's actually for people that have been in EM for 25 years, EM has gotten pretty boring, actually, relative to what we used to do years ago. I mean, waking up in the middle of the night, crisis overnight, trying to get out of positions, dump your positions down. And I'm not talking about the crypto market. This is like what we legitimately did. Sometimes we wouldn't be able to sell positions. You were trying to track them down. They were lost. They were being delivered by bicycle, and the bicycle messenger got run over. And in India, like, this is the type of stuff that really happened. So I do think that there are similarities. It's why between us and then even others, we were talking about it earlier, you tend to see similarities and personalities that do well in these markets. Derivatives, emerging markets, and what was our third one?
FX.
FX.
24/7 markets, not really well regulated. All right, Matt, you famously called 200K by the end of the year with Bitcoin.
Yep.
We're a little far off from that right now. What gets us there? And what stops us from getting there?
Yeah, look, I think we're going to get there. I still am very confident in that. What gets us there is there's a structural imbalance between supply and demand in the Bitcoin market. Bitcoin produces 165,000 new coins a year. Last year, ETFs bought 500,000. We think they'll do that again this year. Corporations bought 250K. We think they'll do that again this year. Governments could buy between 0 and, who knows, 1 million Bitcoin. So there's this structural mismatch between demand and supply, which means the only way that's met is by existing holders selling. And we think eventually this structural demand will overwhelm them. So I think that we'll get there. I think what's going on in the market right now is, you know, as Blue mentioned, there's been an enormous amount of really good news. If we backed up 6 months and said there'd be a Bitcoin strategic reserve and the SEC would drop all its lawsuits and, you know, we'd have a crypto czar, outrageous good news. We should already be at 200K. But there's uncertainty in the market, so that increases the amount we discount risk assets, so the market is down. It's just an opportunity. You know, what could prevent us there is if we fall into a significant recession and the government doesn't blink and forces us to go through an austerity period, because that would keep pressure on risk assets. If we skirt the recession, or what I think will happen, if the government blinks in some way, then I think we'll be at 200K and maybe higher by the end of the year.
That would be nice. So against this backdrop of regulatory de-risking, obviously you now have a new license on life where you can go out and you can start offering probably an entire new array of ETFs. How do you think about that? How do you think about offering that? And how do you think about your product expansion?
Yeah, I mean, it's wonderful to finally be able to do what we wanted to do. You know, it took 6 years to get our first ETF over the line. Now we can launch them relatively quickly. I think there's a huge scope of growth for ETFs. I think 2 or 3 of the largest categories haven't been tapped at all. As an example, we run the largest crypto index fund in the world. It's about $1 billion. I don't think in a $3 trillion market there's going to be $1 billion indexed. I think it'll be 100x that. So I think you'll see index-based ETPs be significant. We think a lot about what you can do around Bitcoin itself. I think people haven't explored that. And then, of course, we look at select individual tokens that we think have strong communities and trading volumes and offer ETP exposure to that. But, you know, you have to pick and choose. You can't launch everything, so we try to launch things into big TAMs or very vibrant markets.
Got it. And Ryan, as a trader now, you're going to have access to a number of different ways to express risk. ETFs, spot. I would still argue there's a lack of futures markets out there that I think is really hurting the market. Hopefully it's something we're going to solve here shortly. But against this backdrop with all these new products, are there new ways that you seek to express risk?
Absolutely. And not only are there new ways to express risk, there is significant dispersion in the assets that you're investing in. So this cycle is, in my view, radically different than the prior cycle. Prior cycle was Fed injects $4 trillion of monetary stimulus, every asset goes higher in price. regardless of its utility, regardless of its protocol, regardless of its revenue. Now we're seeing the kind of tide come out of it, where there is a big fundamental switch between the assets and protocols that will perform and have strong tokenomics and that have strong, revenue base versus not. So over time, I agree with you that there's going to be this dispersion. The way in which you can express that is with futures. I would say that the markets are getting more evolved there. If I told this crowd here that the CME has greater Bitcoin open interest than Binance, maybe people wouldn't believe me, but it's true. They're starting to launch Solana futures as well. The ETH futures and ETFs have obviously been approved as well. And there just is a growing, I would say, tailwind towards more product offerings. More institutions that come into the market right now as well are demanding this for risk management purposes. They're more sophisticated. They're using options. It's all nonlinear risks as well. Structured products are coming on. This is a massive transformation to where we were 3 years ago, 5 years ago, wasn't even heard of. And more broadly, what we're seeing is a compression in implied volatility. So 3 to 5 years ago, it would be quite normal to see Bitcoin trade at 120 vol, right? As more capital has come into the space, there's been greater liquidity, spreads have been tightening, more players. That has compressed realized volatility because we're becoming more institutionalized. And the offering set that investors are demanding includes a greater array of products. So it's spot, futures, options, all the above.
Got it. So, and it sounds like fundamentals are actually going to start mattering for a change?
Yes. I think we're really starting to see that now. And particularly what Matt just mentioned too, post-election, the regulatory, climate was extraordinarily different than where it was. So the lawsuits being dropped, the civil the civil lawsuits that were attacking founders are now less afraid to build what they want to build for fear of getting jailed or fined. And that allows more capital to flow into projects, more clarity brings also, just the institutional crowd closer and closer. We'll go into that, I'm sure.
Perfect. All right, Amy, let's talk about the banks. Everyone's favorite subject in the crypto conference. The OCC came out, I think it was Bulletin 1183, that now said, hey, you guys can do custody. You don't have to necessarily ask us. You're allowed to do it. You can run validator nodes, and you can also, we like stablecoins again, go for it. How is that changing? How is your approach changing now to the adoption of crypto? We've seen Goldman starting, they've have a trading desk for a while. They trade NDFs. How are you thinking about it at Morgan Stanley and bringing this asset class online?
So I think every step we see here, if it's OCC or some of the activity we've seen the SEC this year, it's all positive. It wakes folks up to pay a little bit more attention. But as a bank, you care most about the Fed. And we do need some things to change at the Fed too. So, I think moving in the right direction. The one thing that I would say there, just beyond regulation, I think the thing we keep thinking about is, let's just say regulation opens up and makes it a lot easier for us. We do need to be able to put the infrastructure in place to do this. And I've said this at the first permissionless years ago. I'm against ETFs. I understand they have a function. Maybe it's being an EM person. I want my liquidity 24/7. And also we have clients that want to move assets that they have and potentially bank them with us and be able to leverage all of the features that the digital asset space allows you. And an ETF still has limitations. You're not doing staking in those products. I think we're probably going to talk a little bit about, yield products, which is potential. ETFs is not solving that right now. So we need to be able to put the infrastructure in place for custodying those assets, AML, KYC, one of the most critical things. If it's any example of kind of what we have to jump through, the hoops we have to jump through on a regular basis. When we were prepping for this panel, it's very normal for any panel that I do anywhere in the world. Hey, we have a shared Google Doc. Guess what? I cannot get access to shared Google Docs because of our firewall. So if you just put that in perspective, which is like the most basic thing that everyone that has kids in here and goes to school, like your kids do everything on Google Classroom. I don't do anything, and that's because of the security architecture that we have to follow. So infrastructure for us is still a big hurdle that we're trying to navigate, even if regulation solves itself.
All right, Amy doesn't like ETFs, but Matt does. Matt, what do you say to that?
Well, I mean, Amy's absolutely right that long-term single spot Bitcoin ETFs shouldn't exist. I actually agree with that. The reality is right now, they're better than virtually every other alternative. You get institutional pricing, right? 20 basis points for our ETF, high liquidity, custody trading, et cetera. But long-term, yeah, it's a bridge technology. We recognize that at Bitwise. The bridge probably lasts for 30 years or something. At the rate things are going, but it's not the end game for individual asset ownership. That should be direct, and ETFs will end up being index and others. But right now, it's literally the cheapest way to acquire Bitcoin in the world.
Yeah, I'd probably throw a couple other things that people benefit from the ETF today. It's regulatory certainty, because it's just another security. It's operational ease, because you just press a button on your brokerage account. And then one thing that we should probably talk a little bit about more is security, right? We just had Bybit, and so I would hope that the institutional rails that you're embracing are much more secure, perhaps, than other alternatives.
Yeah, I mean, the core promise of an ETF has always been individual investors get to invest like the largest institutions in the world. And that means world-class security, world-class trading protocols, et cetera. Assets that never touch exchange, that are always in cold storage. And so they absolutely have that. The other really important piece is there's just a lot of money that can't buy crypto.
Yep.
Right? There's 401k money, and there's pensions and endowment money, and they just can't, period. End of story. And so for them, the ETF is the ultimate solution. But absolutely, I mean, right now, the quality of custody and the quality of trading in ETFs is unparalleled, and the price is cheaper than anyone of any size really can get. So it's an incredible deal.
So Blue, how do you advise your clients to engage in this asset class? Is the goal ETFs make it easy? Are you looking to get them into the spot space, derivatives, NDFs? What advice do you provide?
So obviously, T. Rowe is an active manager, and so we would need to exist in a world that is beyond Bitcoin and Ethereum. And so we actually don't have an ETP product. We don't have any products for client use now. But apparently, you can invest in the spot ETPs on our individual self-directed brokerage platform. And I was like, really? Because we should get T-shirts made saying that. So instead, I'm just saying it here. But I think one of the most important things is to consider, the risk profile of the investor. So we're having it's a very different conversation if it is a retirement account, or if it is a 200 million, 1 billion endowment or pension. Those are obviously very different ways to think about both your liquidity needs over time, your risk profile, and your investment horizon. I think it's a little bit easy to sort of say, oh, this little window of percentage is great, and I have a hard time with the same percentage window is the same for everyone. My kids all have custodial Roth IRAs, and my 5-year-old is allocated very differently than this middle-aged mom with dependents, right? And it should be that way. And so I think we just really need to think about who the end investor is and what their objectives are.
Sir?
Yeah, I would just chime in there too, because what the ETFs have allowed, the Bitcoin ETF specifically, is a much more sophisticated investor base to come in, whether that's in a market neutral basis strategy that pairs it versus CME futures. And now with Bitcoin options trading on the ETFs as well, there's a level of sophistication for hedge funds, for market makers to get more involved. All that does is provide more liquidity into the space. It provides tighter spreads. It is, at the margin, more efficiencies. So the type of participant that's come to the market now because of the ETF is amplified way beyond just the long-only passive manager or long-only portfolio allocation, which we can get into, but it's a much more sophisticated array, and it leads to growth across all aspects of crypto.
Maybe just to add to that point too, when you have that, it allows you to just have an asset allocation discussion. And so I think that's one thing that's changed. And I know we've talked a little bit about it on the panel. Also, that it's not just this separate asset class, or hey, let me go park something over there. It's what's the right allocation? How do you think about this? What does it add to your overall portfolio that you have as an individual investor or an institution? So that's getting a lot more real, and we're trying to have more of those conversations about optimal allocation of this space, rather than like, hey, you might want to look at this and park some money over in the corner.
How do tokenized products come into play? So, we're starting to see a lot of real-world assets. I don't say the R word because I'm a banker and I can't stand it, RWA. It gives me the cringes. But we're seeing Coinbase is talking about tokenizing its equity. We're seeing money market funds become tokenized. How do you think about that product from an investment perspective? Would you prefer that or not prefer it? And how is that going to evolve?
So I think that something, so what we've seen to date is that when we talk about tokenized funds, largely at least from an asset management perspective, we talk about tokenized funds. Funds are sort of, it's twinning, right? So it exists in the real world and it exists in the tokenized world. I think no one in this room, including myself, is prepared for the unlock that happens when the underlying securities and assets are on chain. Like, what happens when our equity guys who are patting themselves on the back for T+1 are now, are quoting Netflix in Amazon, right? Like, it's an extraordinary unlock when we see all of those securities come natively on chain. There's a fantastic paper, which I'm sure many of you have read, and I only recently discovered, from Andreas Park from the University of Toronto, and they modeled what would happen if you put U.S. equity markets on an AMM, and it's like a 30% reduction in transaction costs. It's insane.
When I travel to India and the Middle East, and I'm trying to raise money for our funds, also, like, the only thing a lot of those investors want in these local markets is access to Tesla and Apple and every other big tech name, which is very frustrating. But you can see if you have, and I think that's been a big shift too. Like, the tokenized always started in the private side. Hey, we'll these private funds will tokenize them and like offer secondary liquidity. But the public equity market, I agree with you. Like, that's the big. I mean, these investors in other parts of the world are paying 30% premium just to get exposure.
That's pretty nuts. Let's pivot to stablecoins. So we expect to have a stablecoin bill. I think Bo Hines just told us in the next couple of months in front of the president's desk. That's going to inject dollar liquidity on chain as well, complementing this tokenization theme. Matt, what kind of impact do you think this is going to have on markets?
I think it's a certainty that stablecoin legislation will get passed. Huge bipartisan support. I think it'll be great for the crypto ecosystem. It will bring more people into the ecosystem in a major way. I think the specific area that will benefit most are DeFi protocols, which will suddenly open up to a much broader array of audiences. It's like a giant onboarding mechanism into the market. So I suspect it will be net positive. I think it'll be good for layer ones. I think it will be spectacularly good for certain DeFi protocols. And it'll be good for equities that are playing in the space as well. So I think there's a lot to be excited about in the stablecoin space.
And I take it one step further as well. Like, the United States is the epicenter of innovation, capital markets. We already have a $230 billion stablecoin head start on the rest of crypto, right? Stables are denominated in dollars. They buy treasuries, right? There is significant global demand for the dollar. I think that stablecoins are only going to grow in terms of adoption and in use. Amy talks about emerging markets. Oftentimes around the world, people just want a stable reserve of their own capital that they can custody themselves. That not is in a local emerging bank that could potentially fail or devalue. People want exposure to dollars. They want to be able to custody it themselves. So I think it's a huge unlock. And with the legislation that you've discussed, it puts the U.S. at the forefront of clarity, which again will bring more capital on chain and allow institutions to really embrace this. We're seeing this on, in real time, right? Like big names, big traditional names are coming on chain. I'd be hesitant to say names because I want to pick and choose, but like private tokenized tokenized bond funds, it's happening right now. Private credit funds are coming online. These are huge amounts of capital that can be unlocked when you have greater clarity with regards to stablecoins. So I think it's, and put it this way, even with this 25% correction that we've seen in crypto market prices locally, in that same reference period, stablecoins are at their all-time high.
Yep.
Right? So stablecoins are already like 20% higher than the last cycle peak, right? Despite significant dispersion across Bitcoin and across alts. There is very clear demand for stablecoins and also novel demand for derivatives of stablecoins, such as like tokenized synthetic dollar products as well. There are like synthetic cash and carry products.
Yep.
It unlocks an enormous amount of capital.
Totally agree. Did you have something to say, Matt?
Oh, I was knitting together the last 2 points. You know, I think stablecoins teach us everything about where tokenization is going to take off, which is 2 places, and it's not where most of the media covers tokenization from. It's crypto native users and it's emerging market users. Because emerging market users, it's 10x better, and crypto native users just can't think outside of the crypto native space. I think if you're tokenizing products, you should be serving those 2 markets first, and only thinking about sort of wrapping around to more developed financial markets second. I see a lot of people experimenting with like developed markets tokenization, but that's a big step for a traditional investor to make. So I think people can look at where stablecoins were adopted to see the route that tokenization is going to follow.
Yeah, so today we have about 220 billion in US dollar stablecoins. It accounts for about 99% of stablecoins are dollar. I think traditional assets, in traditional markets, around 57, 58% of transactions are dollar. It doesn't seem like this 99% is going to stay there forever. To my friends from the EM space, like, do we expect to see additional non-dollar stablecoins emerging?
I think you have to. So I do just generally think the stablecoin discussion right now is really underestimated how much momentum is picking up underneath the surface here on stablecoins. It could be really transformative, and even to Matt's point, like it could really start to build other things on top of this. I was just having this discussion with someone the other day. It's mostly US dollar stablecoins that get all the attention, and you do need that interoperability, especially if you're going to still have to pay people in the local market. So if you're going to Argentina, if you're going to places in Africa, unless they want to transact in USDC or Tether or some other US dollar denominated stablecoin, which I don't think is going to happen, we're going to need more stablecoins roll out. But I think also there's a lot of discussion about, do corporates have their own stablecoins? Do you kind of go back to back and you have interoperability between like different corporates or financial services companies that have stablecoins? I mean, this is just a big discussion that's really starting to open up right now.
Yeah, I think also I think we touched on that the FX guys and crypto, it's like the dollar stablecoin does an incredible amount to facilitate cross-border payments for non-G7 currencies, right? So, I mean, if you want to do whatever, RG, HEI cross, I mean, the spread on that is a nightmare. But if you can go through the dollar stablecoins, you're reducing so many transaction costs and frictions. So I think that you see a lot of cross-border non-dominant currency like crosses happening through these, and then there have to be there have to be local on and off ramps, because there are still a lot of non-convertible currencies out there. But I think that it goes a long way to strengthening the dollar, and then I think we all finally see, and the powers that be finally get this. We found a huge demand.
Yeah, totally. So I think the stablecoin bill is going to result in a massive injection of dollar liquidity on chain. I want to get your take on where it's going to go, but looking at the FX markets, those are $7.5 trillion a day markets. Most of them trade T+2. It's just a better product. So you got to think in time. That's where we're heading. But okay, so we're gonna have all this liquidity come on chain. It's already at 200 billion. Probably I think it's going to go to about 500 billion by year end. Who knows where it's going to go? That's got to be good for alts, Ryan.
Yeah, I think it's good for the market structure more broadly, right? We're seeing tremendous fragmentation in the market right now. We're based on certain exchanges now coming back that are now able to even offer certain alts. Before it was very, hostile in terms of what assets you can list. So by definition, more liquidity coming into markets on centralized and decentralized exchanges will help. When you really look at DeFi in general, and when you look at like kind of the core oil of like what powers DeFi, it's programmatic smart contracts that run, and at the end of the day, it's USDC or USDT on the other side of it, right? So whatever liquidity pool you're looking at, injecting another 250 billion, right, is going to have a better impact on that capital, right? It's going to have a better impact in terms of the liquidity, and in general, I think more liquidity will produce better price action in terms of like price transparency. The clearing price of risk to the upside and the downside will be just a little bit more transparent and robust. What we're seeing right now is market makers stepping away to a degree, cascading liquidations. This is very local in the past like couple weeks, and that's because of the exchange incidents that you've mentioned, and that causes fear. But when you have more liquidity coming on chain that is deployed into smart contracts, it operates much more smoothly.
Right. But that yields come. I'm sorry. That stable. I got ahead of myself. Those stable coins are coming on chain for a couple of reasons. I think one is for capital preservation in the EM markets that we talked about. But the real driver is yield. Right. Everybody wants yield, and so we're going to be in this environment, we think, where rates are going to be coming down potentially. So Matt, how do you think yield is going to play into your philosophy and your product launch, and like how does yield evolve in these markets and drive investor behavior?
There's massive demand for yield.
Yeah.
Anything yield related attracts significant attention. That's been true in crypto for a while. It will never be more true than it will be in the next few years for the reason that you speak about. So as an asset manager, we think about what we can do in that space. There are a lot of things. I think a lot about yield on Bitcoin right now, and we get a lot of inbounds from very wealthy Bitcoin people trying to generate a few percent, and so we think a lot about that from a product perspective. I think, services that tap into the yield that is available in stablecoins, which is still supply-constrained market, are pretty exciting, and we think about that and how we fold that into fund opportunities. So, I think it's one of the biggest product development opportunities for an asset manager.
Can you talk a little bit about ETH? Because I've always thought that the ETH ETF is awful, because ETH's a wonderful product. It has limited supply, has smart contracts, and it has this thing called yield, but Gary didn't let us offer yield. So now that Gary's no longer with us, how do you go about restoring yield to ETH?
Man, I didn't know this was an anti-ETF panel. They didn't put that in the title.
No, it's great, but
it's a great product, man.
But the yield, how do we get the yield back?
Look, I think we're going to get to staking in ETPs. We run ETH staked ETPs in Europe. They work great. I think we'll get to that here. It's slightly more complex because we're dealing with regulations from the 30s and 40s. So how you do yield in a grantor trust is like something for lawyers to figure out. But you can do it. You'll absolutely do it. I suspect it'll happen by the end of the year, but I don't know that. And I'm not speaking about our filing, just more broadly. You should be able to do it, and you should be able to handle the liquidity constraints that come with it. I will say I don't think it's transformative for ETH ETFs from an AUM perspective, because most people investing in an ETH ETF want 50% returns or 100% returns, and 2 or 3% is like nice but not great. What we saw in Europe is that you got new flows when you launched a staked ETP, and the old ETFs didn't get new flows. So it switches where flows go and it increases them, but it increases it incrementally. ETH ETFs are going to end up being 10, 20, $30 billion products, but only when ETH gets its vibe back and people, it starts to benefit from all the stablecoins and DeFi and tokenization and agentic AI that's taking place there. The staking will be nice, but it won't be transformative.
Yeah, and I love ETFs, by the way, just pointing out the little thing about the yield that we'd love. But
we'll get there.
Let me push back a little bit on that, because I think when I talk to a lot of my traditional hedge fund peers, they say, I want two things. I want basis and I want leverage. Leverage is hard to come by. Basis I kind of see. I don't know. My sense is that when you're able to trade total return against spot, and you can lever that up, that's going to be a really interesting basis trade for a lot of the traditional funds that are now coming in that aren't in the space today. Because if you go long and you're down 5% in a month, you're out at some of these big hedge funds. We're down or up in 5% in 5 minutes.
Absolutely.
So how do you think about basis?
I think you're absolutely right. I do think I think it's imperfect, right? I think it's imperfect and becoming more perfect, and that's a part of the stack that uses the fund, right? Right now, it's really long-term, long-only investors who want exposure to this asset. That's it. And you're talking about these other pieces that are part of the ETF stack. So right now, those won't come in, and so AUM is lower. But but again, we will get there. I think we will get there.
I was just going to say, when you zoom out and we look at really if we were having a staking yield or not in terms of, ETH ETFs, it may be a little narrow because what we're really talking about here is the bigger zoomed out trade of our lifetime, a trade of my lifetime for sure, which is directional long exposure to digital assets now is, in my opinion, the only asset class that is growing on the planet that has a larger right tail than left tail, period. I can't look at stocks, bonds, commodities, FX, and say something similar. And we have just experienced massive tailwinds that were previously significant headwinds. So a 3% staking yield annualized is meaningful, but for a very sophisticated investor who's probably already doing that on chain anyways, right? The greater discussion is what is a relatively modest amount of capital allocation from the traditional pie allocated to digital assets, and what does that do over the the long term? And when I say long term, I'm also including the demographic consideration here, which is in 15 years from now, there's going to be one of the largest wealth transfers of a generation that is going to come down, and it's going to come down from retirees and baby boomers into young professionals right now who are going to be at senior leaderships in various organizations, very comfortable with digital assets, very comfortable with implementations, very comfortable with risks that are associated with them. And it's going to feel and be just as seamless as what your Web 2 experience is right now. So zooming out, yes, the staking yield is quite important, but it's the bigger picture is that this asset class is the only asset class that I could see that's poised for growth.
Got it. All right, last question, and we're going to go back to the title of this panel, the trade of the millennium. So I think you talked about it already, Brian. It's going long tail alts. Is that what I'm hearing?
Well, it's a combination of all, right? So Bitcoin is definitely going to be the kind of gateway, if you will, into the space. Most investors get their head around that. This is now beyond a white paper. This is not an abstract thought anymore. This is actually happening. As education improves and as people get more involved, they start to learn about L1s, L2s, protocols as well. So it's a risk appetite there. But certainly there's empirical evidence to support that even a modest allocation to digital assets improves the Sharpe ratio of an overall portfolio of traditional stocks and bonds. And I think that the time is not any more clear than now. Especially considering this drawdown that we've just had in markets broadly. This is a very attractive personal opportunity time. So,
Good setup. Amy, what's your trade of the millennium?
I mean, as an EM person, I will still always love Bitcoin. Being able to do the peer-to-peer, not having any intermediaries, being able to access 24/7. I know I will always get someone that'll tell me quantum is going to kill it and you will be poor. That's fine. It's just, it's still for me one of the purest and clearest trades out there. I do believe in the whole the whole digital asset space, though, and I do think there's so many opportunities from ETH and everything that's being built on that, all the way down to the stablecoin solution. So I think there's more than one trade here. Bring it into every aspect of your portfolio and really learn the underlying technology.
Blue.
So I think that I also, coming from a macro, very distressed debt background in EM, Bitcoin just resonates with me, and it's what brought me into this space. I was like, I get it. I know what a sovereign balance sheet should look like, and I know what it should not look like. But I actually think that it is a diversified multi-token exposure across the board. Yes, Bitcoin heavy, but exposure across alts.
And Matt, sir.
Yeah, the way I invest is that, my own capital mostly in index funds in crypto. I will say, the setup for Bitcoin, as mentioned, is just so good. We have chopped off all the existential risks. The last one was that governments might ban it, and somehow we co-opted governments, which is mind-boggling even to me to this day. I don't know if they know it happened, but it did. So I think we're left only with sort of the tail on the right, and I think it's beautiful. But I'm excited about everything in crypto as well.
Awesome. Me too. Well, please join me in thanking the panelists.
Thank you. Very good. Thank you. That was great, Matt. Great work. Okay. Next up. We're going to talk about Bitcoin lending, and it's going to be centered around that. So please join me on the stage and give a warm welcome for John Glover. Hey, John. How you doing? Drop that one there.
Hi, everybody.
Okay, John, let's just kick it off quickly. Quick intro about yourself, quick intro about Ledin.
Sure. My name's John Glover. I'm the CIO of Ledin. Ledin is first and foremost, a lender of dollars against Bitcoin and ETH collateral to the retail sector globally. But we also, on the other side of that, need to fund that book. So we're also a very big borrower of dollars backed by Bitcoin.
Perfect. Let's just start it simple, right? Why Bitcoin? What makes Bitcoin this pristine collateral for this kind of job?
Well, I come from many, many years in TradFi, as a lot of us do. And when I look at the collateral that we were accepting when I was in the banking world, they were things like T-bills or stocks or other asset classes that had distinct trading hours. So they were open from 9:30 to 4:30, Monday to Friday, no holidays, closed on weekends, closed in the evenings. And so you had price gap risk. When you're accepting that as collateral and you have a liquidation threshold, you've got this gap risk that, you've got Tesla stock that you've taken as collateral and Elon does something crazy over the weekend and Tesla opens 10% lower and now you're exposed to this potential loss. So Bitcoin has 24/7, 365 markets, very, very deep and growing liquidity. So you just don't have that exposure to, something going wrong when you're sleeping and the market's closed.
Yeah, okay, perfect, makes sense. So how about you give us a more holistic view of the Bitcoin lending space in general, how we've come from a couple of years ago from the, the Celsiuses and the BlockFis of the world to where we are now.
Yeah, I mean, it's been a really interesting journey, especially for someone who already had a lot of gray hair to start. I've got a lot more since I got here. But so when I joined Ledin, I was hired to help with the risk management of the firm. And when I looked at what some of our competitors were doing, it was really concerning to me because they were paying yield on tokens that didn't have an institutional lending market, so there was no way to generate yield on the tokens that they're paying yield on. We were approached by people like Three Arrows Capital to lend them money, but they wouldn't share financial statements. They weren't transparent at all about their creditworthiness. So we didn't lend to them, but our competitors were. So there were a lot of concerns that I had in the way the market was growing. And I've got just this little anecdote to tell. We had a board meeting where one of the board members said, "Why is Ledin not as big as BlockFi?" And I said, I have no idea how they're as big as they are because we're growing as quickly as we can, and they're growing 10 times faster. They can only be doing that through taking risk. And then it was like 8 months later that everything blew up and BlockFi went out of business, and we remained in business because we just did, I'm not even saying it was groundbreaking risk management. It was just traditional, smart risk management in credit underwriting, in market exposure, in making sure that we were very transparent to our clients and what they were doing, in protecting our own balance sheet and protecting our clients' assets. And so we were able to survive. But what happened when Celsius and BlockFi and Genesis and Voyager all went bankrupt is trust left the marketplace for a long time. And so we suffered from that because people thought that we may be the next BlockFi. So we saw our retail loan book go from about, I think at the time it was around 300 million in outstanding loans to about 45 million, because people just paid back their loans because they were nervous about losing their collateral, like some others did at BlockFi or Genesis or Celsius. And so it was a matter of building back up that trust. And also we knew that since we survived and we did things the right way, as long as we could stick around long enough for the wave to come back in, that we would do well. And so what happened in March of last year, when everything kind of took off again, we saw our loan book grow, and we're now almost double what our maximum loan book size was prior to the events of FTX and Alameda, et cetera. So it's been very good,
It's always sad to hear, and it's a very common theme in the space, where the bad actors, malicious or otherwise, end up taking down the rest of the space with them, especially reputational-wise. But let's dive a little bit deeper. So how does your Bitcoin-backed loans differ from a traditional loan that most of us are used to here?
Really not that different from, we're not trying to reinvent the wheel here. We're just trying to bring traditional financial products into the digital asset space. And it's very easy from a North American perspective to just go, well, if you need money, why don't you just borrow it from the bank? Well, first off, we've got a lot of clients who are really digital asset rich, but don't have a lot of real world assets or even really high incomes. And they can't borrow against their Bitcoin collateral at a traditional institution. So that's a big portion of our book, but it's just like taking out a loan against your car or a mortgage against your house. You're just taking out a mortgage against your Bitcoin. And then if we look at our Latin American client base, which is quite a large portion of our exposure, they don't have access to traditional financial institutions, period. Even if they have other assets, they just can't borrow against them because that's really for the wealthy in some of those countries. And so that's another place. They come to Ledin to access to unlock some of the wealth that they have in their Bitcoin, just to pay bills or to buy a car or to pay for the kids' education or to go on holiday, or in North America to start a business or to buy a house, etc. So it's really, to go to your question of how does it differ from traditional lending products, it really isn't different. But it does have that pristine nature of the collateral, so it's quite a safe lending protocol.
Okay, that makes sense. It's not a different loan process. It's more that the collateral itself is more inclusive, permissionless, global. Okay, makes sense.
And a faster loan process.
Right, and 24/7, transparent, right. Okay, so on that note, so you mentioned Latin America. Let's talk more about your customers. Like, who else are there? Is it institutions, hedge funds, retail? And like, what are the typical loans that are coming to you for? What are the purposes of this? Yeah, let's just tackle that.
So we've got a number of different kind of cohorts of borrowers at Ledin. So we have our minimum loan size is $500. So we are retail focused primarily. Our average loan size is around somewhere under $50,000. But we have tens of thousands of these loans outstanding. We also have loans up to, I think our highest loan right now is $5 million or $7 million in notional. So it's a lot of high net worth individuals. It's a lot of retail clients. We have some corporate clients now that have treasury that they want to borrow against. They want to put that to work. And they are in, I think, 122 countries around the world. So it's very diverse. You asked about use cases. It's kind of what I was talking about. It's to pay for their kids' education. It's to rent a bigger apartment. It's to buy a car, go on a vacation, in some cases buy property, or to invest in other asset classes. So take out a dollar loan and invest it into traditional asset classes.
And then with these customers, how long is these typical loans? Are they repeat customers? Are they coming off for other services? Like, can you go more into that?
Sure. So all of our loans are a 1-year term, but you can repay at any time without penalty, because consumer lending laws require that. Our average loan duration is around 160 days. But we have loans that are much longer. Like some people will just renew their loan every year because they still have need of the asset and their value of their collateral keeps going up, so they can take more loans against the collateral that they have. So it's really varied, but we do see our average client takes out about 1.3 loans per year. So even those that are getting paid back, they tend to take out another loan later in the year as they need it.
And is that growing? Is that number trending upward? 1.3?
It has been growing, which is great because we want to make sure that our clients are getting as much utility as possible as they can. But also, as I mentioned, as the value of their collateral goes up, they've got additional collateral that they can take out a loan against. So they'll add to their loan balance by just taking out a second loan against the existing collateral that they have.
Okay, very interesting. So how are you funding both? How is it being funded, the demand side of this and the supply side?
So I said we've got kind of two facets of our business. We have the retail side, which is really where the vast majority of our dollars go to the retail lending. But we need to fund that. So we have a couple methods that we can fund. We have growth accounts. We call them growth accounts. It's like a savings account where you can put USDC or USDT on deposit with us, and we'll pay a yield for that. The way we generate that yield is lending to our retail clients in an over-collateralized basis. That's one small source of funding. It used to be quite large when we could offer that in the US and Canada. We can't do that anymore. So that's only maybe 15% of our book is funded through that. The rest of our book is funded through bilateral loan agreements with larger players that are wholesale lenders into the space. So we over-collateralize to them with Bitcoin, and we use that to fund our retail loan book. One name that's public that we can talk about is Sygnum Bank out of Switzerland. They did the world's first syndicated Bitcoin-backed loan was done for us, and so that's one of our sources of funding. And we have other counterparties like that.
And you mentioned you're not allowed to do those similar loans in the US and Canada anymore.
The savings accounts. We can't offer the savings accounts, yeah.
Do you expect that to change anytime soon, given this new administration?
I would think that it probably will change, and hopefully it does because it gives people access to higher yield on their dollars. There's a ratings agency in the crypto space called Agio Ratings. We had them rate our business. They rated us at A-, which is like investment grade. So it gives people confidence that this is a safe way to generate yield on their dollars. So hopefully we'll be able to offer that again in the US at some point.
And I assume when they did this rating, this methodology, they looked at your risk methodology, how you would require rebalancing of collateral based on LTV. Can you go a little bit more into this risk methodology that you have?
Sure. So all of our retail loans start at a 50% LTV. So if you want to borrow $100,000, you need to put on deposit with us $200,000 worth of Bitcoin. Once that LTV hits 70%, our clients get an automatic notification that their loan is getting into liquidation territory. So you may want to add more collateral or pay down part of your loan, but get that into a healthier territory. All of our loans are they're measured for LTV every 60 seconds, 24/7. As soon as that LTV hits 80%, we liquidate their collateral in a sufficient amount to repay the principal and accrued interest. The loan gets repaid. The balance of the Bitcoin collateral is then given back to the client. We've done $1.2 billion worth of retail loans across, I think, 57,000 or 60,000 individual loans, and we've never lost a penny or Satoshi on any of the loans because of that methodology.
Never lost a Satoshi. That should be the slogan there. That's a great track record. Okay, that's great. Coming up on time, I want to circle back to the first question, right? Bitcoin as the pristine asset. You're all a Bitcoin-backed lender. Let me ask this in a kind of funny way. Are you all Bitcoin maxis? Do you all see yourself offering these similar products on any other asset besides Bitcoin, perhaps Ethereum, perhaps something else later down the line? What are your thoughts there?
First off, I wouldn't say that we're all Bitcoin maxis, although we do have some Bitcoin maxis in the company for sure. But no, I think we're all big believers in digital assets, very big believers in Bitcoin. But more believers that we should be able to level the financial playing field around the world and give people access to financial products. To your question on will we accept other assets as they'd rather do that than post it as collateral. So they're happy to keep their Bitcoin intact. They don't want to wrap it and put it onto DeFi. They just rather keep it intact, post it as collateral, and borrow against that.
No, that makes sense. I mean, for Bitcoin, as of yet, there's no Bitcoin DeFi. There's no way that you can trustlessly just put your asset and earn yield on it. So, I mean, Ethereum, there's some alternatives. For your Ethereum product, though, do you have different loan-to-value ratios? Is it more volatile? Is it the same exact? Yeah?
No, it's all the same. We plug it into our same technology. And as I said, we've never had a loss from that. The volatility of Ethereum is not high enough to concern us that our tech's not correct for that.
And then, in a similar vein, in the future, I mean, there's teams working on Bitcoin DeFi, right? Through these L2s, through these other chains. Do you see that will create more demand in general for Bitcoin lending? Do you see it as a competitor? I mean, how do you view that?
Well, I mean, already there's competition from DeFi lending. We think that it's very different subset of clients who are interested in that. I think if Bitcoin truly can be used on-chain as collateral in the DeFi space without changing its formation, so without wrapping it, without having to bridge to another protocol, I think that will open up more demand, and there will be people who would rather do it in that fashion. I think the difference from a CeFi lending perspective and the clients that deal with us is they want to make sure that it's that there is AML KYC, and then they're not going to fall foul of any kind of regulatory or tax implications. So I think there's a place for both, but we'll see when that really develops, and we'll see how it works out.
Also, you give me your thoughts here. I think another hindrance with DeFi lending is that the rates are all variable, and they can change as quickly as the crypto markets change on a weekly basis. So I don't know if you have thoughts on that.
Yeah, for sure. I know there's some projects that are being worked on for fixed term, fixed rate lending that's going on now. That's really just more of a matching book and find people who are willing to borrow at those rates and lend at those rates. Yeah, variable rate is definitely challenging for people. People want the certainty of knowing exactly what they're going to have to pay month on month if they have to. By the way, you don't have to pay monthly interest to us. It's all bullet payment at the end, which is one of the big differences with ourselves and our competitor. But people want to know that, get that certainty. So I think that until that market develops more, there'll be more demand probably for the CeFi space where it's fixed. So when you borrow from us, you know exactly what your interest rate is. You can pay that back whenever you like, but you know that for the next year, that interest rate's not changing.
Okay. And last question here. What are the big plans Ledden has over the next year? What are you bringing into the space?
Well, we've got some plans on the funding side, which I'll be excited to announce when it's done, but we're not there yet, because one of the biggest challenges for everyone in this space is access to dollars, and I think the last panel talked about that a little bit. We've developed some really great funding relationships with really strong partners, but the rates are still relatively high for an investment grade borrower like ourselves. If we were to be doing this in TradFi, we'd be paying 5%, 5.5% for dollars. We're paying a lot more than that for dollars because there's just not access yet. What we're working on is going to be unlocking that for us in the TradFi space, which is really exciting. So that'll be announced at some point. And I think really what we're working on is not to do anything that's groundbreaking. We're just working on bringing more traditional finance type products into this industry, and doing that in a very simple way. We're big believers that the best restaurants have the smallest menus. We're trying to be very focused on being the best Bitcoin-backed lender into the space, but adding things like auto top-up features so that if you are getting to that 70, 75% LTV, you can automatically have your Bitcoin that you've got with us moved over into your collateral pool. Because once it gets in the collateral pool, it's locked in there. So you don't necessarily want to over-collateralize beyond what you have to. But if you've got excess Bitcoin, you can have that sitting in a transaction account, as we call it, and it'll automatically go and top up your Bitcoin collateral so that your loan becomes healthy again. So things like that are facilitating ease of management for our clients. That's the kind of things we're working on.
Okay, great. Perfecting what already exists. Love it. Everybody, thank you, John, for your expertise.
Thank you very much, everyone.
Cheers. Thank you. Okay, next up, we're going to be talking about the maturation of the crypto cycle. So give a warm welcome for Thomas Kladek, Chris Lawn, Michael Higgins, Nikhil Viswanathan, and Tim Renew.
Hey. That on? Cool. So, hi everyone. So next 40 minutes we'll be discussing with my four fellow panelists the evolution of the infrastructure of this ecosystem. We're super lucky to have very experienced people that blending like traditional markets experience and crypto specializations. So maybe just as a quick start, if you want to introduce yourself, your company, very briefly.
Yeah, sure. I'll go first. First and foremost, many thanks to Das and the entire team for organizing the event and giving me the opportunity to speak today. Quickly, by way of background, my name is Mike Higgins. I'm the International CEO and Global Head of Corporate Development at Hidden Road Partners based in London. Prior to helping set up Hidden Road 6 years ago, I spent 20 years in electronic trading, multi-asset, and a bulk of my time in the foreign exchange markets. Briefly on Hidden Road, it's a multi-asset PB and clearing firm that was set up and funded by the buy side. So it's a sell-side business funded with buy-side pension fund capital. We've been focused on two things. One is to improve the technology behind the core infrastructure of prime clearing and margin finance in the traditional assets, and then applying those applications into digital. And second is we've taken an innovative approach to bring balance sheet into capital markets, including digital, by tapping into the large pools of private credit. And so summing up what we do as a prime broker, we're really access providers, access to two things. One is give access, uninterrupted access, I should say, to our clients to trade across the entire liquidity landscape. If you look at digital, it's highly fragmented across exchanges, OTC, and more of the regulated rails, so full access there. And then access to balance sheet, that's our balance sheet to trade across all of those in a capital and cost-efficient way.
I echo Mike with thanking Blockworks for the opportunity to speak today. Hi, everybody. My name is Chris Lawn. I'm CEO of Elwood Technologies. Our headquarters is in London as well. By way of background, my predominantly was global macro trading buy side, where I either built or ran trading desks or had a portfolio myself. I entered the digital asset space in 2017, and it's been quite a ride, for sure. And prior to becoming CEO of Elwood Technologies, I was on the Brevin Howard Principal Investment Team. It's been really, really remarkable what I've seen over the last few years, and we're getting there. So who and what is Elwood? We're a product and engineering-led technology company. We are SaaS. We are FCA regulated. We are front-to-back OEMS, PMS, risk system, and IBOR. We give our clients the ability to transfer risk across the digital ecosystem with our proprietary algos built by quants. We ingest that risk, whether you trade through us or anybody else. We view our post-trade as risk capture. Our responsibility is to work with our clients to make sure that we reflect your risk live all the time, basically. We have live reconciliation, and then we essentially have risk metrics that are dozens and dozens of risk metrics, and we have a portfolio management and construction tool and an IBOR. So at the end of each day, if you're a fund, we will mark your books and records, which will lead up to striking NAV. We think of ourselves as a connectivity engine, so we are across the entire ecosystem, market data providers, venues, LPs, credit providers, fund admins, you name it, we're connected to it. So we are in the space, we know what we're doing, and if you have any questions, feel free to, do we have Q&A?
I doubt we'll have time for that, but
Okay, well then I'll pass it on.
Cool, thank you. I feel like if I don't thank Blockworks and keep the tradition, then I'm going to break it. So thank you for the opportunity to speak. I'm going to keep with the tradition as well. We're headquartered in London, so you've got a lot of headquartered businesses here. So I'm Tim Renew. I'm Deputy CEO of BCB Group. My background is not actually from digital assets at all. So I started in e-commerce marketing, very different, built a business that did that. Big investment from PayPal. That got me into fintech. Then I built a company that does real-time payments, powers real-time payments for businesses like Bank of America, Citi, National Australia Bank. And then I joined BCB 9 months ago to kind of take that on the journey because of the growth and what I was seeing in the market. And so BCB probably has the coolest name from every business here. It stands for Bitcoin Bro, right? That's a badass name. Started off as a OTC trading desk back in 2017, and then realized it was impossible to get a bank account. And so once eventually managed to get an account, realized that we should kind of pivot and offer this services to the market, the ability to access banking partners. Since 2017, we've scaled massively. We now are regulated in the UK by the FCA, regulated in France, by the AMF, regulated in Switzerland. We're about 160 people. We provide payment accounts in circa 30 different currencies, provide stablecoin payments, crypto payments. Last year, we moved about 235 billion in fiat payments. So yeah, we're kind of core infrastructure for about 350, 400 of the leading exchanges, liquidity providers, and market makers within Europe and Southeast Asia. I'll hand over.
Cool. I'm Nikhil. I'm from Alchemy. I'm basically the polar opposite of all these guys on the panel.
You're not from London?
I'm, first off, way
So
worse
thank you.
dressed. Not nearly as nicely
We
suited.
start fancy and gradually get worse.
Yeah, exactly. I'm not from London. I'm from rural Texas, so opposite of that. I don't work in finance. I haven't been in doing stocks for 20 years. I didn't even own a stock till a few years ago. I didn't even have a credit card till a few years ago. I instead spent my college coding AI systems at Stanford, and then spent the next 10 years doing that in my dorm room, not dorm room, but apartment room with my co-founder. We built a software company. How many of you have heard of AWS? Raise your hands. Okay, so kind of like half the room. Every time you open Uber or DoorDash or what Google Maps, or not Google Maps, but any app you use basically, Amazon actually powers all the computers that power that app. So if you open, every time you open Uber, Amazon makes money. Anytime you open a crypto app, we are powering the technology underneath that. So if you look at, you're playing with Robinhood, or you are buying something potentially on Coinbase, or you are buying an NFT on Facebook, or you're trading on DeFi, or looking at an NFT, we're powering all the technology behind that. So very opposite experience, but a lot of fun. To give you a sense of scale, we worked for like basically 10 years with nothing, and then 2021 was a really great year for us. The ecosystem took off, and the company grew really fast. The last run we did was at $10 billion, and we do about over $100 billion in transactions annually. So you probably would not have heard of us, but we are the kind of under the scenes, behind the scenes technology powering the apps you use every day.
Okay, cool. That's very interesting. I think all of us have been, one way or the other, involved in the space for the last 5, 6, 7 years. And the way I like to look at things is kind of finding the defining moments of each one of the different verticals. And so maybe, Nikhil, you mentioned like 2021 was clearly one defining moment. Maybe you want to spend a bit more time on this one and define exactly what it was, and then each one of you can share his own kind of defining moment.
Yeah, I think you guys will talk more about the banking fintech side. So let me address more the technology side. So a little bit historically, 2017 was when a lot of people started getting into crypto. We actually got into crypto because we were building a social app company, and the guys downstairs we'd play beer pong with were building a crypto Bitcoin company, and then we would always talk about Bitcoin, and that's actually what got us into crypto. 2017, 2018, 2019, 2020 was kind of this, hey, this crypto thing's kind of interesting. But when the market crashed, everyone said, yeah, that was fun, but we're done with that. That was not a real thing. 2021, you saw the first few like consumer use cases, namely NFTs. How many of you own an NFT? Raise your hand. Okay, a few of you. So 2021 is the year that really took off. After that market crash, you saw, so for example, we were working with some of the large banks, and they had these research teams building crypto projects. And so, for example, like loans on chain or tokenized equities. However, those were siloed to a few engineers in those large banks. The names are NDA'd, so I can't really say, but some of the banks that you guys probably use today. And after that, there was this uncertainty of, will crypto come back? Is it actually going to be a real thing? Coupled with the Biden administration kind of really strong crackdown on crypto, we saw there were small pockets of technology teams inside financial institutions, but they were scared, and there was a lot of risk on the core business of these banks and financial institutions, so they were effectively blocked from doing that. I think the last 3 weeks to 4 weeks have been probably the biggest shift we have seen. So there's 3 things that really need to happen in order for crypto to take off more mainstream, and we're seeing progress in all of them. The first one is the technology has to mature to get scalable enough. And you see with all the layer 2s coming out, with Solana coming out, you see chains that can actually have close to the number of transactions that it would take to sustain major applications, if not exceeding that. The second thing is you need a good user experience. And there's a lot of technology advancements, things like account abstraction, that have made it possible to have great user experiences today that weren't possible 4 years ago. And then third one is regulatory. I'm sure most of you guys are familiar with the repeal of SAB 121, the OCC charter. There were a lot of things that absolutely flipped the bit in terms of banks and financial institutions and fintechs being allowed to build in crypto. And what we saw, at the risk of offending everyone in this room, you guys are not the fastest moving in general. And when I say you guys, I mean the Bank of America, the JP Morgan, these type of institutions. After the SAB 121 got repealed, the number of inbounds we got that said, we need to talk to you today or tomorrow. I was like, that is not a word you guys typically use in general. So given those 3 shifts in technology, we're seeing a massive rush from all financial institutions across the board, asset managers, fintechs, banks, to come jump into crypto. And I'm happy to talk later about what people are building.
Yeah. Maybe as we talk about banks, Tim, you want to jump in? I mean, clearly it is. I mean, we've seen the on-ramping of ramping 6 years ago was a disaster. It's getting better. Not that long ago, 12 months ago, we had a bit of a kind of banking crisis in the US as well, and that really dried up the liquidity for crypto traders and crypto kind of active businesses. Maybe do you want to elaborate this with your perspective?
Yeah, of course. So I think when you look at the world, most industries are led by the US, I think. Most industries, everyone looks at the US, what they're doing. Again, not to offend everyone in the room, but I actually think crypto was very much seems to be powering ahead across Asia and Europe a lot faster than adoption in the US is. And that was kind of enhanced with back in 2023 when you had things like Silvergate and you had Signature, you had Silicon Valley Bank close, and as you mentioned, the Biden administration's stance on crypto, maybe the SEC stance, meant that no one wanted to put their head above the parapet and stand out and work in crypto. And so, I think you find that a lot of institutions found overnight their access to US dollars was closed off, their access to a banking partner was closed off. And you can't operate a business if overnight you're shut off. And so we saw a massive influx of people coming to us. We sit in front of 12 banking partners, so one integration, one onboarding, and as banks change their risk appetite, we can just flip between different banks and different institutions. So I really think that was one massive defining point. I think another one that is really big for European businesses is the introduction of MiCA. I think it's a great first step, and I think it's a great launch. And I can cover off more later how regulation is playing a role globally. But is it the right move? Is it the right stance on stablecoins, for example? I'm not too sure. I think the MiCA regulation is about 2,000 pages. I haven't met a single person that said they've read all 2,000 pages of it, so I don't actually know what's in there.
We're not going to ask who's read it.
Exactly. So I think those are 2 massive moments, and I think everyone's now looking at how MiCA is rolled out, what happens there, and they're going to kind of launch that, and that's going to influence maybe what the US does, what other markets do when they try to regulate this. But
Sure. Defining moment for Elwood Technologies. A couple comes to mind. We had a Series A in 22, and just after that, we recognized that there was a need in the market from an institutional perspective. There really wasn't regulated software that was out there for the institutions that at least I worked for. Big hedge funds, banks, or asset managers. They wanted to make sure that there's a robust, resilient product that's out there. And so we decided to go from our origins, which was essentially an EMS, to an OEMS, PMS, risk system, IBOR. And so we see we see institutions across the, different categories. And when we made that decision, it was validated with FTX. And during the FTX crisis, our clients were able to trade across ecosystems, obviously not on FTX, but we were able to help them from a risk management perspective, collateral management, We were, we are support 24/7, 365. So that was a defining moment, and it was good to, feel that and see that the business strategy change was validated. I think the other one was, mentioned SAB 121, and then the ETF. We were an OTC desk. We had an OTC desk, and we decided to divest that OTC desk and focus on fintech and providing software for the institutions that are coming to the space. And I agree with my colleagues here that since the election, really since the ETF launch, since the election, SAB 121, we've seen a steep curve in, we're educating again. We're educating again. We were educating before FTX, and now we're doing it again. And I was at Boca last week for the FIA conference. Just a quick story, quick takeaway, was there were two types of, two feedbacks that I got. One was essentially, we know digital's here to stay. We are prepared or preparing for it. We know digital, the other one is we know digital is here to stay. We have no idea, how to engage with it. And what I found, what I took away from that is they want to partner with institutions or technologies where we can provide or integrate data back into them. And that's what we do. They're looking for reporting. They're looking for risk metrics. They're looking for real-time reconciliation. They're looking for help. And it was very, very, very good to hear that they're looking for help. And I think it's great for this industry. One last thing. I think the industry needs to come together and work together in order for us to go and partner with the institutions. The institutions are looking for help, and we have to do it together. So I'll pass it to Mike.
I think there's dozens of defining moments, as you clearly said. I'll try to pick some different ones, but maybe piggyback on some. So there's two that I think about. Number one is the blow up in the lending markets that hasn't been mentioned yet, and the second is the launch of the U.S. Bitcoin ETF is a major milestone and a watershed moment. But on the first one, that started to unravel in 2022. I think it was May of 2022 when UST Luna blew up, and then the following month, Three Arrows, who was a large borrower from those lenders, defaulted. That started this domino effect, and ultimately you saw the likes of Celsius and BlockFi, and ultimately ending with FTX. But I think it's important to kind of unpack those business models. Very early on, they were basically raising capital from retail investors, promising yield that those assets sat on their balance sheet. They then lended those out on the other side and captured a spread. And so when the market became a little bit quiet and they couldn't lend those out, some of those lenders started using very aggressive terms. I mean, some terms we've heard are $300 million uncollateralized. You don't even find that in the traditional space. Worse than that is they were lending to firms that didn't even produce financials, let alone audited financials. So I think when we look back, we're going to point to the wild, irresponsible, unsecured lending as an area that blew up. On a more positive note, the launch of the U.S. Bitcoin ETF is certainly a big moment. It's important for one thing and one thing only. It truly opens the U.S. market. The U.S. market is a very, very, very equity-centric market. And derivatives are effectively a sideshow. If you look at the number of futures accounts versus equity accounts, it's a fraction, right? So it's not to say derivatives are not central to investing, but getting Bitcoin into a regulated, acceptable equity format is the last and final step in opening the U.S. And so with that, we've seen greater liquidity, greater product development, options, ADRs coming online. There's been a net positive on the native Bitcoin cash market. Greater flows and new entrants require greater accountability and greater accessibility. And so overall was a big moment for us. I think the other one that we didn't talk about is just like the ETF to help maturing the market, the recent talk by central banks to potentially put digital assets in their reserve could actually be the inflection point going forward. If Bitcoin is a permanent store of value, then it would absolutely make sense that central banks would hold it like gold. Gold is expensive to purchase and expensive to store. It's expensive and environmentally difficult to get out of the ground. Bitcoin is a much more efficient store of wealth. And so, again, I think this could be like the year that it happens. Geopolitically, we're in a period of sustained inflation and protectionism, so I couldn't think of a better setup for a hard asset that preserves value. So we'll see how it unfolds, but that could be the true way that Bitcoin finds its full expression. I'll pause there.
Yeah, well, kind of going back to the infrastructure. I mean, if we look at the crypto-specific infrastructure today versus the parallel of the traditional kind of market infrastructure, and if you had to look at what has been potentially just created for crypto usage, I mean, 24/7 markets, very fragmented, et cetera, probably brings like more complexity than potentially even in traditional market. And if you had to compare it to the journey of other asset classes that we've seen over the last 2 or 3 decades, how would you qualify, looking at your own business, what is an evolution or kind of an integration of what has been done in traditional market, and what's more like a bit of a revolution or of a new way of doing things? Maybe just starting on the PB side.
Yeah, I'll kick off. So through the lens of a prime broker, we actually view digital assets as very similar to traditional assets. In fact, on the technology side, we wrote a single horizontal clearing infrastructure using modern technologies and techniques, kind of from high-frequency trading, and bolted that into a clearing business. That's important because it allows us to have a real-time, holistic view of a counterparty's risk, cross-asset, cross-product. And so it's the same platform that I clear foreign exchange, listed derivatives, fixed income, that I do digital assets. And so from a technology perspective, don't see much of a difference there. As a prime broker, we do basically 4 things. And they're all very similar to digital assets as in traditional markets. The first is that our actuaries are experts in underwriting counterparty credit risk. And so that underwriting process of counterparties is very similar. The types of institutions in crypto may be smaller. There's a little bit more on the KYC and the wallet side of things, but ultimately the process is similar.
Are you able to integrate DeFi as well?
We don't support DeFi at the moment because of the KYC scenario, and that's a problem for that. But we're starting to see permission pools, so at some point. But just to kind of quickly finish, the other 3 things that we do is we manage liquidity that's on our balance sheet as we provide sheet to the street. We manage term liquidity, so we give term loans, same kind of concept in traditional as well as in digital assets. And finally, the actuaries set a series of limits for our counterparties. So again, on the technology side, the way the mechanics of this work is we set a series of limits. We push those out programmatically to all of the destinations where clients trade. They trade. We consume in real time post-trade drop copies or those events to the edge of our system. And we do effectively 2 things. One, we put it in our ledger. And so that's the books and records, and spits out a series of reports, regulatory reporting. And the other is into the risk engine, which recomputes the risks and pushes out new updated limits. So again, very, very similar. There are the nuances that digital assets is 24/7. You have different tenures and settlement windows that could be instant. You have different decimals, and those don't fit into some of the back offices of traditional players. But overall, again, we see it similar. The last thing I would say is on the evolution side, I always comp digital assets to foreign exchange. And if you look at that market, how it evolved, it was started by institutions and then retail came in. Digital assets is the opposite. It started by retail and you have institutions coming in. So we have a different set of problems on a different period on the evolution adoption curve.
Okay. Chris, I mean, did you have to rebuild the whole kind of layers infrastructure of the PMS, or were you able to adapt and make it evolve to properly address?
Mike stole my thunder. So I'm just kidding. Look, Mike said it correctly. It was a retail market. I believe that it was revolutionary, right? It really was, if you think about it, peer-to-peer. It was brilliant. I mean, nothing short of brilliant that the products that are coming out of the digital asset space, for sure. But it is retail. And if you want institutions that are regulated to participate, there needs to be a coming together, so to speak. Just for example, it was mentioned before, I mean, 24/7, 365, that's a big deal. That's 40% more support. 40, 2 extra days a week. How do you manage your risk on the weekends? How do you manage your your portfolio on the weekends? Do you strike a NAV on Saturday and Sunday? We solve all that. But ultimately, the way I think about it, in order for this space to really take off, and if we are institutional, we are regulated, we are seeing an increase in closings and education and demos and all that. But predominantly, what I think needs to occur is that there needs to be settlement clearing, essential counterparty clearing, which Mike has touched on, which is his business, so I'm not going to go into that in too much depth. But in TradFi world, where I came from, the PB network, FCMs, PB equity, PB FX wheel, the banks settled on behalf of their clients. The market and global capitalization, market capitalization took off exponentially. So if you want this space to take off, we need to have settlement and clearing in a safe and secure way, and credit, cross-margining. The next one is we have jurisdictional fragmentation. I mean, it's honestly, I probably could get in trouble saying this, but I find it absolutely unbelievable that the perp contract, which I think is fantastic, is not in the United States. I really do. And a US person can't trade that product. So how do we solve that? Really, we have three options. Either the international derivative exchanges change their framework to operate in the United States, or the US person is allowed to trade on those exchanges and to access those products, which are innovative, or the US builds those products. And if the US builds those products, we're going to have a bifurcated market, right? Which is more fragmentation, which is what we don't want. And so, you know, I think it's very important that that's solved. And lastly, I'll finish up with this, is standardization. I mean, there is no standardization because it was a retail market, marketplaces, and the infrastructure that was built around it was to mitigate that and give you access. There's no standardization, and Mike touched on it, and so have others, for APIs, right? In the traditional world, we have fixed. The APIs in digital world are not standardized, and they have issues. Symbology, decimals, workflows, processes, product fungibility, right? Each marketplace has their own products. So I think the industry, we've done a great job, and we need to pat ourselves on the back. It's been amazing. But we need to standardize, and we need to come together and work with the coming institutions, because they're coming.
I love that we're just going up and down the line, but I'll go next.
You're going next, but what I've been curious, I mean, obviously you're providing the on-ramping, off-ramping, the banking like service support that many of the bigger potentially kind of institutions are not yet willing to provide. How do you see this kind of evolving over the years? You're going to be an add-on, you're going to be a facilitator, you're going to compete with the banks?
So I think this is where this industry talks about, so like I said, I've only been in this industry 9 months, but there's too much of this them versus us mentality. It's them versus us, TradFi versus DeFi. And if you look originally when fintechs were kind of invented or came about, everyone thought that the fintechs were going to come and eat the lunch of the banks, right? The big banks were like, no, it's against fintechs. But realistically in the world, you needed both, right? You need the ones that have been successful is where a fintech has learned to work with a bank, where you get the innovation that fintech brings, you get the speed to market, the talent that go and want to build new cool stuff, and then you get the customers and liquidity that a bank provides and the scale that a bank provides. The two of those you can't compete with. And I think that's what's going to happen to this market. I think there's things that we do extremely well. I think there's things that the traditional finance market and traditional banks do a lot better. So if you look at something like the Basel Accord that allows standardization globally on how banks work across the globe, there's no standardization if we go to regulatory setups. If I want to get regulated in Dubai versus Singapore versus any other market, maybe come to the US, there's no standardization. What I need to do in one market is completely different to something else. And because this market is moving at such speed, we're making mistakes. I mean, not to go into too much detail, but things like APP forward in the UK is in concept to protect the consumer is a great thing. You want to be able to support them. You want to make sure that you cross out fraud. But the way it's been implemented just instead stops people wanting to work in the market. So you get anyone providing retail services to consumers just pull out of the market. They just don't want to do it. And then businesses like ours are then left in limbo, understanding the rules, what we're liable for, how much we need to pay. So I think standardization, and it's using the same term, is one thing. And then one thing that maybe they could take from us is, again, using the same theme, 24/7. So we see huge demand for our Blink network. A lot of people will have known like Silvergate's Send network. We basically have a Blink network that powers instant settlement for fiat 24/7, multi-currency, multi-entity. And that is something that I think TradFi would really need to adopt, is like this notion of, I can't transact after 5 p.m. on a Friday. It's just like, it's like, how are we still in that position? So I think there's things we can take from both, and we need to just stop doing them and us and just start working together and moving forward.
But is there, we see that there is real demand for some of these things, right? But I think, Chris, when we were doing the prep call, you mentioned that actually some of your potential clients that are more traditional, kind of larger ones, they don't want to trade over the weekend. They don't want to price over the weekend. They like long weekends, I guess. How do you, and I guess, we'll revert back to that, but where do you guys see right now the biggest demand? Is it from crypto bros? Is it more from traditional market? We're talking about the maturation of the infrastructure, but quite frankly, the infrastructure, the way it is today, for what you do, if you're a crypto trader, it's probably good enough. If you're a bigger shop, then you need more complex, you need the capacity to move balance sheet everywhere. So I'd be curious to see where do you see the biggest demand, and how we can basically bridge that gap. Nikhil, maybe you want to start with, I know you have a bit of a differentiating kind of view and approach to this, but from your standpoint, where do you see the biggest demand for your solutions today from your client base? Would be interesting, and then diverge more to traditional finance again.
Yeah, totally. How many of you guys are in traditional finance versus crypto? Raise your hand in traditional finance world. How many of you come from the crypto world? What do the rest of you guys do? It's like half the people. Okay, I wasn't sure if I was going to share this, but what I'm going to do is kind of like strip out any identifying information, secret plans, all that kind of stuff, and share what we're seeing. So to give you a sense of scale that we do, I think I mentioned earlier, we do like over $100 billion in transactions annually, every country in the globe. If you're using something in crypto, we're probably powering under the hood. There's a secret playbook that we are developing for financial institutions, and it's obviously different financial institutions, a bank versus a consumer fintech app versus an asset manager, have different needs and different customers and different products. But in broad strokes, there's a playbook, and here's the playbook. It's 3 pieces. Number 1, you give users access to crypto. That can be in whatever form. It can be an ETF. It can be in you custody crypto and Bitcoins and ETH for your users. You build a system that lets them self-custody. That's one of the pieces of software we have. Users can come self-custody assets. In whatever form, you let them access it. Because if you don't let them access it, you are going to lose that user. I actually just moved all my money from JP Morgan to another bank, because hopefully they don't watch this video and see that, but because they didn't allow me to custody my crypto there. That's number 1. The second one is utility. Now that you have your crypto there, what can they do with it? Can they access DeFi loans? Can they get yield on it? Can they lend it out? Can they do staking with it? And the reason it's really valuable is because there's a lot of ways you can make way more money on yield on your crypto than you can on a dollar. And that is something that all users will want. And if you are a asset holder, or you hold assets for your customers, and you don't let them do that, they will move somewhere else. That's piece 2. So number 1, hold crypto. Number 2, use that crypto. Number 3, the kind of next piece that everyone's really excited about, bring your existing business on chain. Is that stock trading? Is that real world assets? Is whatever your product is, make a tokenized version of that. And you get a lot of the benefits that these guys were talking about before, 24/7 trading. It's much cheaper on the, much less complex and much cheaper and much faster on the back end side. It allows you to tap into new markets. It allows you to tap into a ton of liquidity. And if you look at the US Treasury bills, stablecoins, and this was several months ago, is like the 40th largest holder of US Treasury bills, more than most countries in the world, right? So stablecoins lets Treasury bills have a massive user base that they couldn't have before. So, and then there's one kind of secret fourth thing, which we'll talk about. So first one, access funds or hold your funds. Number 2, use those funds. Number 3, bring products on chain. The fourth one is launch your own chain. This is a really, really, really exciting, unique opportunity. It will only be around for next 6 months to 1 year. But I don't know if how many of you guys know this, but Coinbase actually launched their own blockchain, and they make hundreds of millions of dollars on that. And you can think of it as owning like a credit card network effectively. You get to be Visa, and you get to take interchange fees. And today, there's no dominant traditional finance blockchain. The first couple people who come have that opportunity to do that, whether it's a massive bank or a fintech, everyone's rushing to do this. So that's kind of the fourth secret piece. We actually power all those solutions. So if you're interested in learning more about this, reach out to me, come see me afterwards. I think I see Paul over there, right there. Come talk to him or email me. My email is just nikil@alchemy.com. But the point here is like, there is a gold rush right now. The winners will be set in the next year, but after that, there will still be a lot of opportunity, but whoever acts first will have this like magical opportunity and untapped potential.
Cool, thanks. I mean, clearly you're talking to people that are moving fast, and there are some people that are moving less fast. But so, I mean, kind of, Chris, going back to the point you mentioned when we're preparing for this, i.e. the demand you see, and I mean, what realistically we can provide as infrastructure, and what is the real demand, and what do you think could be those additional kind of features that could actually kind of bridge that gap and facilitate like the better integration over the next few months? What do you see it as the major ones?
Well, like I said, I was at Boca last week for FIA. We are institutional, so we're predominantly a buy side, front to back, end-to-end, OEMS, all the way through the IBOR, risk system, portfolio management. So we are modular. What we're seeing recently is some of the digital infrastructure providers or custodians are asking for our help on one part of on our product, specifically around reconciliation, because we've built a scale reconciliation from the old institutional side about tri-party reconciliation. We built it out at scale. Just one aspect. We are definitely seeing digital natives that are institutionalizing, asking for some help with respect to making sure that our forte, which is essentially accurate record keeping and risk and trading, and so we help them in that regard. We're seeing that. That's occurring as we speak. Okay. For institutions and hedge funds, we're seeing more and more. We are educating. We are in talks with a large asset manager about how we can support them, an international multi-billion asset manager, not a hedge fund, asset manager, how we support them and build out bespoke reporting. So it is occurring, and we are seeing it. And because we are end-to-end and we are modular, we're being asked for specific parts of our stack. Yep. So preferably, we would prefer turnkey, where someone comes in and they trade with us. But we know that EMS is, in the TradFi world, commoditized in many ways. But post-trade, I think that we're seeing more and more. Demos every day and closings, and we're doing well, and it's good to see, and it's occurring. Yep. But it's definitely started after, in my view, since the ETF, SAB 121, and the election, and it picked up significantly.
Cool. Tim, do you need like more banking relationship? What are the next step for you? I mean, is it kind of having a broader, kind of more stable network, or is it better kind of solutions for the end clients? What's the thing that's going to make the change?
So I think for BCB, it'll be kind of doing what we do, just expanding our footprint. So whether it's regulatory-wise, we plan to get regulated in the Middle East, in Singapore, and hopefully come to the US as well. So that's going to be big for us. We're always looking to grow the currencies that we support. At the moment, we support 30+ currencies, but we need to keep on adding on local rails for that. I think that's going to be a big thing for us. But also, the demand we're seeing from institutional clients at the moment is, it's one thing you said about wanting to get into kind of Bitcoin treasury is a big thing. I think you just see the success. I actually heard a great story once about Metaplanet's success, where they were the best performing stock last year, And it turns out that in Japan, apparently it takes 6 weeks from you wanting to buy crypto to actually being able to buy it. And the final step is they have to send a physical postcard to your house to prove it to you, like an actual postcard. And so it's so complex to get it that people are just buying Metaplanet stock because it's they're just a Bitcoin treasury business. And so that, along with moving into again, stablecoins mentioned, the ability for bridging using cross-border payments with stablecoins. We have the ability to kind of take in any currency and pay out any currency, whether it's coin, whether it's stablecoins, whether it's fiat. So I think expanding what we do, expanding our coverage, our Blink network, those are kind of the key things for this year that we're definitely going to see coming.
Cool, thanks. Mike, do you want to bring more traditional players to crypto or more better solutions to crypto traders?
I think
what's the biggest push?
I think we still need, like, we're really far away from the basic building blocks, right? Investors, retail and institutional, have their assets invested in 6 assets, right? It's equities, credit, rates, real estate, commodities, and cash. If crypto's the 7th, then its trading and investment mechanics need to migrate towards other asset classes that trailblaze before them. And so that'll be a number of things. It'll be financial transparency. We need to get into this space. You need to improve clearing, custody, credit. We need to separate. The number one thing we need to do is separate the function of trading from the function of asset holding and collateralization. And by doing that, it'll lead to best practices across both of those disciplines. Once those building blocks are in place, then the institutional users can come in. And I'll give you one quick statistic. Foreign exchange markets in 1995, the Bank of International Settlements did a report and showed the market turnover was $1.2 trillion a day, with 0 going through PB because the infrastructure wasn't there. Fast forward to 2019, the market cap grew to 6.6 trillion, with 1.5 trillion a day going through prime brokerage. So it just goes to show, as you lay down infrastructure, markets can scale. Prior to PB coming online, there was no industrial scale in foreign exchange. There was a few bespoke deals. There was no broad usage. It was just the mega names, the Tudors, the Soroses, the Moore Capitals. And because there was lack of institutional grade infrastructure, a lot of institutional capital sat on the sidelines. Similar story in crypto. Lack institutional infrastructure, institutional capital sitting on the sidelines. So once you solve that, then the institutions will come in. But I think my colleagues, did a great job, and the retail who built this out has been exceptional. And so we need to work together with that. My fear is shoehorning it into existing stuff that might suppress when we have the opportunity to create something new and unique.
Cool. Well, I mean, thank you guys. Thanks very much. I'm not sure we've fully there in terms of maturity, but I think we've gone a long way already. Thanks very much for sharing your experience.
Thank you. Thank you very much.
Thank you.
That was an insightful talk. I think one thing that resonated me there was the industry is educating again. It halted for a couple of years, but now the digital asset space is educating again. And I think, that's what part of this conference is about. So it's really lovely to hear. Up next, we have our very own Cassie Wagner and Sam Golden from Rootstock. They're going to be talking about the convergence of Bitcoin and DeFi. So let's give a warm welcome for Cassie and Sam.
You can sit.
This is my key, huh? It's all
Oh.
good. Yep.
We're set. Hi, I'm Casey. I cover policy and regulation at Blockworks. And I'm with Sam Golden, who is the Director of Brand and Communications at Rootstock Labs. Thanks for being here.
Thank you for having me. Super exciting to be in New York as well. Hi, everyone in the audience. I know it's quite late on the first day. Thank you for sticking with us.
Sam, I wanted to start with something that you mentioned when we were talking off stage. You said that if gold and fiat is kind of like fiat is a layer 2 of gold. And that's kind of how you think of layer 2s on Bitcoin, as like we like to call it digital gold. Can you kind of explain that and kind of get into what Rootstock's focus is there?
For sure. Yeah, I mean, it's like quite an old analogy now, like Bitcoin is digital gold, but I think it rings really true in terms of security, scarcity, and value. And for a long time, until the introduction of modern banking, gold was used for the means of transaction by everyday people. 16th century, 16th, 17th century, introduction of like the paper-based money kind of paved a new way for how gold was used as an asset. And I think we're seeing the same thing with digital assets here, where you've got Bitcoin as the digital gold, and now layers being built on top of Bitcoin that enable the additional functionalities that a fully fledged financial system need. Like, so payments is one, but there's so much more to a financial system: lending, borrowing, insurance, investments, savings. Not all of that can be enabled on Bitcoin on the base layer due to it being pretty expensive to transact with, not having much programmability. And so the layer twos give Bitcoin the ability to expand beyond the store of value and into a fully fledged financial system. And at Rootstock, that's what we've been leading since 2018. So building a DeFi layer for Bitcoin that allows people to be able to do all the other stuff that you might want to do with Bitcoin as an asset.
Yeah, definitely. And I want to get into Bitcoin beyond a store of value, but given all those use cases, can you kind of give us a general overview of the current landscape of Bitcoin L2s? Where are we? How have we grown in the last year or so? Where do you see us going? What are you working on?
Yeah. So it's really interesting, like the emergence of Satoshi even referenced the idea of other blockchains sharing the hashing power security of Bitcoin back in 2010. And the early entrants into the market were people like Lightning Network, who basically make, as we just talked about, this layer above Bitcoin. They make payments much faster, much cheaper, based on Bitcoin. Around the same time, in Argentina, a few cypherpunks who are really focused on Bitcoin started thinking about their own economy, the capital controls and hyperinflation they were seeing, and took that to basically combine the programmability of Ethereum with Bitcoin security, and that's where Rootstock kind of emerged. And then over the last year, I think as a result of some tech advancements, things like Taproot, BitVM in the world of Bitcoin, and also macroeconomic factors like the Bitcoin Strategic Reserve, ETFs, all this kind of stuff. There's been a big wave of new entrants into the Bitcoin L2 market, which is good because it kind of validates the theory that we had that all roads lead back to Bitcoin at the end of the day. And now you're seeing kind of layers emerging on top of Bitcoin for everything. So Lightning Network, very focused on payments. Rootstock, the kind of DeFi layer for Bitcoin. And then you're seeing a lot of other networks coming out with specialisms in things like NFTs, collectibles, that kind of things, all kind of forming around this market. And as a result, we're also seeing a lot of venture capital funding coming back into the Bitcoin space as well, which is really interesting to see.
Yeah, I want to get back more into the kind of triggers that you mentioned with Bitcoin. You mentioned the strategic reserve, which is certainly a newer development. ETFs, which we got in the last year. What kind of, in the last, we'll say the last 12 months, do you think kind of sparked a new interest in Bitcoin L2s, and how did that develop?
Yeah, I think some of those factors played a role. I think there's also, and at Rootstock Labs, we talk about our kind of purpose is making Bitcoin work for everyone. And I think a lot of people had started acquiring Bitcoin, either institutions holding it in a treasury or individuals, and they wanted to figure out how to turn it from a store of value to a productive asset. And so a lot of these opportunities emerged to do that. Especially now, you're seeing the altcoin market kind of detaching from the Bitcoin price as a whole, and Bitcoin's remaining pretty consistent. It has dropped a little bit in the last few weeks, but compared to the kind of wider crypto market, it's held its own. And I think that comes as a result of more institutional adoption. One of the last panelists talked about MetaPlanet. There's also obviously MicroStrategy, taking Bitcoin as a pure part of their treasury as a business. I also have Strike as well, the same people doing that. And I think it's giving a lot of credibility to Bitcoin as an asset. And because of the security and scarcity of it, people are seeing it in the same way as gold and being like, okay, we can start using this for more than just a store of value. And that's what all of these layer 2 solutions allow for with Bitcoin. And maybe we can talk about it a bit later, but there's also trade-offs and trust assumptions with how you use your Bitcoin and put it to work in different ways.
Yeah, definitely. I mean, being at the Digital Asset Summit, it's definitely more of an institutional conference in terms of the crypto conference circuit. You mentioned institutions being able to put their Bitcoin to work beyond just, a store of value, beyond something that they have on their balance sheet. What are the challenges that institutions face when trying to get more into DeFi?
Yeah, there's a few big ones. I think like number one is like security, like understanding you retain control of the asset. So making sure that if you've got Bitcoin, you want to earn yield on that Bitcoin, at the end of the day, you still have custody of that Bitcoin. Incredibly important, whether it's your own treasury or if you're working on your client's behalf to put that asset to work. I think obviously there's a big regulatory question. Different markets that we look around the world will have different regulatory frameworks for how Bitcoin and other assets are used. I think it's been great in the last few months to see more clarity in the United States in terms of regulation and this kind of thing, and pushing forward for like clarity. Because a lot of the time, I think that's what people want. They want to have like a list of rules they can look at and say, okay, I'm doing it by the book here. When there's like kind of not that level of clarity is when people start not being clear on what they can actually do with their assets. So that's going to be increasingly important in the next year, is not just the United States, but around the world, more regulatory clarity around Bitcoin as an asset and the wider crypto market, for those institutions then to understand how can I harness these layers built on top of Bitcoin to put these assets to work, earn yield on them, maybe take a loan out against them, maybe issue some kind of tokenized bond to raise money for the business. Like there's lots of different ways that Bitcoin is starting to be used in that way. But I think like institutions have to get comfortable with the security around how they want to put this Bitcoin to work. And then the other side is understanding the regulatory framework they're operating in and whether they can, what they can do, what's possible with the Bitcoin they hold.
I want to get more into security. I think that certainly is one of the biggest challenges for institutions. I'd love to hear kind of how you think about that as an issue, but also I think there's a big critique of sometimes security and decentralization not always existing in the best way, maybe sacrificing decentralization to get more security. How does Rootstock think about that and kind of balance those issues?
Yeah, I mean, that is like one of the biggest questions. Like, I think decentralization is like a weird concept because there's no like real end goal. Like we always talk about being on a path of progressive decentralization. I think in a lot of projects adopt kind of decentralization theater, this idea that things are fully decentralized and there's no centralized control. But there's always going to be points that can be improved and further decentralized. And that's kind of over the last kind of decade since Rootstock's white paper was published. We've been on that journey to basically dismantle any kind of centralized entity that needs to control the ecosystem and allow it just to operate on its own. How do you do that? Like from a technical perspective, there's lots of different things to do. I think one of the biggest considerations, not just for Bitcoin, but for like crypto as a whole, is like bridges, like moving assets between blockchains is not only one of the biggest kind of like points of security risk, as we've seen in the past with multiple bridges being hacked, but also decentralization risk as well. Like there's so many projects and new chains that have launched where the bridge is literally a custodian. It's a multi-sig wallet where you are sending your funds in, they're being locked in this wallet that someone else controls, and then you're trusting that the asset issued on their chain will always be redeemable for the asset that you deposited into their multi-sig. And we've seen in the past that isn't always the case. So how do you solve that problem? With more expressive blockchains, there's now like loads of innovation in like zero knowledge proofs to be able to allow you to make more trustless bridges. Bitcoin lacking the programmability of some of those chains, it makes it way more challenging. And that's one of the biggest challenges that like the Bitcoin DeFi industry as a whole has been trying to solve over the last few years. It's like, how do you create that trust minimized or ideally one day completely trustless bridge between Bitcoin and another chain? I think the approach that Rootstock has taken, and lots of the core contributors who work for Rootstock Labs and like kind of wider contributors in the ecosystem, they talk about it as a kind of defense in-depth approach to security. So what originally, like 6-7 years ago, emerged as the primitive thing I just talked about, a multi-sig, has now evolved to a pretty complex bridge where no centralized actor can control the funds that are moving in between Rootstock and Bitcoin. This is done in like, as I talked about, like multiple layers of security. I think what's really interesting is there are 9 trusted organizations around the world, including the likes of Zappo Bank, who hold these hardware security modules. Each of those hardware security modules contains a private key for a multi-sig wallet built into Bitcoin that allows transactions to flow in between the Bitcoin main chain and Rootstock, the side chain or the DeFi layer of Bitcoin. Those hardware security modules are completely tamper-proof. No one can access the private keys inside them. They're geographically dispersed around the world in data centers. And not only that, there needs to be a cumulative amount of actual hash power from the Bitcoin miners to sign the transactions that flow in between Bitcoin and Rootstock. So you're then basically abstracting like no one knows the private keys for the network. The hardware security modules cannot be compromised by anybody. And then there's a final fallback mechanism. So if some catastrophic event happens, it probably will be worrying more about where our Bitcoin is. There's an emergency time lock that basically then releases all the Bitcoin in the network back to the people who deposited it in the first place. So worst case scenario, people get their Bitcoin back from the DeFi protocols inside Rootstock. Best case, and I mean, the bridge has been live since 2018. It allows this trustless flow of Bitcoin. And then once you move your Bitcoin into Rootstock, that's where it can then be, it's like DeFi ready. So in the same way you do with Ethereum or any other asset, you can start deploying it into liquidity pools, you can start earning yield on it, you can start getting loans against it. And that's a really powerful thing because then it basically means you don't need the other tokens. You can use Bitcoin as the asset to access all the same kind of DeFi that you used to on multiple chains with similar trust assumptions, which is really cool. I went a bit deep there, sorry.
No, I appreciate it. We like getting technical on the investor stage. You mentioned bridges specifically and kind of Rootstock's security measures there. In terms of, I guess, connecting Bitcoin to the broader crypto economy, how is that, with bridges, with other things, how has that improved recently? Where do you see that going? Why is that important for institutions?
Yeah, so I think one thing that's really interesting that happened, I think in October 2023, a researcher called Robin Linus published a white paper called BitVM. And the idea was to be able to compute anything on Bitcoin. And this has kind of given birth to multiple different teams working on this solution. And BitVM allows you to basically do zero-knowledge proofs on Bitcoin to have much more trust-minimized bridges in the future. It's very early stages, but I think this is like something that Rootstock Labs and the BitVMX projects, but also lots of other different teams, guys at Starknet, lots of other projects are working on basically cracking this. And if you can do this, you can create an even better bridge to Bitcoin that has ever existed before, which I think is going to be really important for like kind of evolution of how people think about bridging into Bitcoin. I think that's going to make a big difference to like that challenge. I think there's also like a lot of proposals to Bitcoin Core. So like despite many people seeing Bitcoin as this like fixed thing that never changes, it does change very slowly. There are dedicated contributors who are like working on introducing new Bitcoin improvement proposals to the network. There's many proposals live at the moment that would allow for better bridging in and out of Bitcoin, potentially more programmability of Bitcoin and lots of other improvements as well. I think one of the reasons why the core devs of Bitcoin are so hesitant is because it's such an incredible, the system is so simple and powerful in the way it is. People are very reluctant to make changes. 10 years ago, there was loads of BIPs being implemented into Bitcoin all the time, but as the network has grown and the importance of the network has grown, people are much more hesitant to introducing new things, but it does happen. I think there's things like OpCat, BIP 300, which is by a guy called Paul Sork, which is basically a drive chain proposal to Bitcoin. All of these different technical things will make Bitcoin, well, it kind of, as I talked about before, there could be a world where all roads lead back to Bitcoin. Bitcoin is the core asset. There can still be tokens built on top of the Bitcoin network, but the proof of work of Bitcoin and Bitcoin as the asset starts becoming increasingly important. And I think we'll continue to see that in the coming years.
Yeah, definitely. So we've talked about security, we've talked about bridges and innovations there. You mentioned regulation a little bit. Definitely in the US is shifting or has shifted, is starting to shift. We'll see. I don't want to get too speculative, but as we only have a couple minutes left, looking ahead into the rest of 2025, what innovations do you think institutions are going to start to adopt? How do you think they're going to start to either change or shift the way that they think about their allocation to Bitcoin and DeFi?
Yeah, it's a really good question. I think the first step that still hasn't become widely adopted is institutions considering Bitcoin as a piece of their treasury. Larger organizations obviously do not hold all of their assets in cash. And Bitcoin should be seen as an asset that could be adopted as part of a sensible treasury management program. I think beyond that, and this is where maybe we go like further on, it's then how do you turn that Bitcoin into a productive asset, not just a store of value? We're already seeing some of like the kind of front runners like doing this already, but I think this will become way more common to understand like, can I get a loan against my Bitcoin to fund expansion into a new market? Can I generate a sustainable yield in my Bitcoin and then maybe pass some of that savings and the value of that back to my customers? Like, these are the kind of things I think institutions will start thinking about. The reason I use sustainable as a word there is there's already a lot of projects out there promising sometimes astronomical yield on Bitcoin. And the big question is always, where does that yield come from? I'd love people in the audience to tell me where your yield comes from, because I think it's a very complex subject. And I think that like a lot of people are making very like bold promises about the kind of yield they can deliver on assets that already appreciate an astronomical value when you think about Bitcoin as an asset. And that's something that there's going to be a lot of focus on. It's like understanding where does this sustainable yield come from. So a lot of companies thinking about yield generation strategies. And I think also like maybe this goes back into like collateralized loans, but I think like the US government already talks about this, or I think maybe Michael Saylor proposed it for the US government, is issuing like basically like gold bonds, but Bitcoin bonds to be able to raise money for the government or an institution is another thing that I think people will start seeing Bitcoin as like the potential to do that in the same way we did gold like for the last 3,000 years.
Everyone wants yield. I think we know that. And then really quick, just Rootstock in 2025. Can you tell us anything? What are you guys working on? What are you excited about?
Yeah, it's really interesting because like I talked about before, like this new wave of entrance into the Bitcoin L2 market kind of validated our thesis of like Bitcoin becoming kind of critical infrastructure for the future of finance. And as a result of that, we've seen a wave of a lot of inbound inquiries from institutions around how to put their Bitcoin to work, managing those solutions. So thinking this year, there'll be a lot of like big announcements around how more institutions are harnessing the power of Bitcoin's DeFi layer, Rootstock, to actually be able to do more with their Bitcoin as an asset. We've been working really closely with a company called Fairgate Labs on BitVMX, which is, as I just talked about, a way to build better bridges to Bitcoin. We have the Union Bridge coming to Rootstock, which will be using this BitVMX technology to be able to create a more trustless bridge between Bitcoin Core and Rootstock. Last year, we saw a wave of kind of blue chip Ethereum protocols like SushiSwap and Uniswap integrate Rootstock. I believe that trend will continue over the next year as well. And then finally, I think like one of the things that I'm super excited about seeing like in Rootstock in general is like this wave of new builders. Like we're almost seeing like a bit of an exodus from Ethereum. People realizing I can now do the same thing or build the same thing or launch the same project that I was on Ethereum on Bitcoin using Rootstock. We already saw the trickle of this at the end of last year. We saw a lot of like kind of new builders and projects coming into the ecosystem. We saw more established projects building on Bitcoin using Rootstock raise capital from like a load of like big established VC firms. I think we'll see that trend continuing, and we might even see the first kind of like super consumer-facing mass adoption of Bitcoin DeFi by like a wider audience, and that will not only be institutions but also like kind of mass market as well. So looking forward to seeing that.
Yeah, watch out Ethereum. Thank you so much. It was really a pleasure, and thank you guys.
Thanks a lot.
Thank you, Casey and Sam. Personally, I'm looking forward to seeing Rootstock's next implementation with BitVM, so that should be on the cards. Our next panel, we're going to hear about from Jason Yanowitz and Eric Peters from Coinbase Asset Management, what institutions are actually buying this cycle. So let's give it up for Jason and Eric.
Yeah, right there. It's good. How are we doing? Good day one? Yeah. All right, good. This is going to be a lively conversation. We have Eric Peters, CEO of Coinbase Asset Management, also CEO of One River. If you don't know One River, they were probably the first like real institutions to start allocating to crypto. So very excited for this this conversation. Welcome.
Yeah, thank you.
Yeah. You've been trading and investing for a little while. I think you said the other day when we were catching up, this is the most interesting time in markets that you've ever seen. I'd love to just get your view on markets. What is happening right now, not just in the crypto markets, but in the global macro markets right now?
Yeah, sure. I've been at this since '89, so I've been at it for a while, and it is the most interesting time. I mean, there've been some very interesting periods throughout my career. I think what is remarkable about this one is that there's a real transition from the previous paradigm, which was dominated by central bankers, to politicians now. So I think that happened during COVID, and actually that was our impetus to get invested in crypto. We saw this transition to extremely large fiscal spending, deficit spending, which I think was rational coming out of COVID. But what we thought was, well, now that the politicians are engaged, politicians love to spend money, and for years they just kind of turned over the economy to central bankers. But once politicians are engaged, we thought, okay, now we're going to start seeing some real spending. And so, like, for instance, one of the dynamics that's changing right now that's remarkable is that the Germans, just today, they passed this resolution to allow them to spend massive amounts of money in deficit spending. And this is in reaction to a political move, which was Trump more or less not pulling out of NATO, but more or less walking away from NATO in Europe. And now, yet again, you have a politician who's saying, okay, well, we need to respond to this, so we're going to borrow a ton of money, 500 billion euros, and we're going to spend it on defense. So these types of dynamics are just, they haven't really existed politically over the course of my career.
Yeah, and that's an interesting note. It's the first time maybe, at least that I've been alive, I don't know if this has happened before, but it feels like the market decisions from the top are now politically driven instead of maybe economically driven, right? Decisions about maybe rates or easing or tightening used to be driven around like unemployment or things like that. Now it's very politically driven. Is that a short-term phenomenon, long-term phenomenon? Is this just how it's going to work from here on out?
I think it's long-term, as in decade plus. The era of the central banker was literally the entirety of my career, so '89 up until really 2000. And the thing about central bankers too is, like, if you look at central bankers around the world, they've all more or less studied the same from the same textbooks, just in different languages. And so the amount of policy homogeneity when central bankers are in control globally is remarkable. When you get politicians involved, I mean, Trump is different from Biden, is different from, name your politician. So there's just a lot more dispersion, a lot more volatility when politicians are in charge. And I don't see any reason, like, is Trump going to turn over control of the economy to Powell or the next central bank? Like, there's just no chance, right? So it's like that period is gone for a long time.
Yeah, maybe let's actually go there. So if you talk to probably most people in this room who focus on the markets, their view, I think there's starting to be a consensus view that the reason what Trump is doing right now is he's kind of getting us really close to a recession in order to strong-arm Powell into lowering the 10-year, right? He's basically saying, this is the one area of the economy I don't have control over. I'm a real estate guy. I want to decrease the rates, which will long-term help the market and help a lot of different other things. What is your view of that?
Yeah, I think that we're still early enough in this administration where Trump loves to blame people for all sorts of things. I think he can blame Biden for a lousy economy, and I think he already is doing that. And I think when you look at Bessent just this weekend on Meet the Press, he was pretty clear that we need a reboot of the U.S. economy. We can't rely on the deficit spending that we inherited from the Biden administration. And he's talking about recession. Trump's not denying that there could be a recession. I think these guys are preparing us for 1 or 2 quarters of what they hope will be a shallow recession, and then kind of coming out of that, you can get economic acceleration into the midterm elections, which are incredibly important to Trump and the Republicans.
Do you think he has the guts to take us into a recession and stay there? Because the other side of this would be, yeah, you got to do hard things for a little bit, and Doge, and there's all this cutting and the tariffs and a whole bunch of other stuff that's happening right now, causing a lot of uncertainty. But yeah, I don't know if he's got the guts to, maybe this lasts for another 60 days and then he cares about the market too much.
I probably would have agreed with that statement a year ago. I think just the way he's behaving is increasingly dogmatic about wanting to make real change in the economy. And one of our advisors for our firm is now his chief economic advisor. And so, I've followed pretty closely their views in terms of how they think about crypto, but also how they think about the real economy. And there's a strong need for economic change, and I think they really believe that. So I think that if we had a market crash, it's a different issue. But I think some market weakness, not an issue. And Scott Besson is someone that I've known for years as well. I mean, he is a super savvy practitioner, and you look at some of the things that he's doing that will affect crypto and this Bitcoin reserve. They're super clever economic things. I think that they want to make real change here.
What do you think is so clever about it?
Well, so they revised that Bitcoin Act, and one of the things that they did in there. So the question was, how are they going to pay for Bitcoin? And I think the obvious response was, all right, these guys are not going to go out and issue treasury bonds to buy Bitcoin. And I would have agreed with that strongly. I still agree with that. But that doesn't mean that they can't figure it out. But the question is, well, how do they figure it out? And so there's this thing called the Exchange Stabilization Fund. And so currently the Fed has $11 billion of gold marked on their books. Okay, this was set up in, I think, 1935. The last time it was, I don't remember when it was last revalued, but it's valued at something like $42 an ounce. So what the Treasury can do, what Besson can do, is have the Treasury revalue its gold. Let's say they revalued it to market. That is about a $750 to $770 billion gain. Okay, the Fed can then transfer that cash to Treasury. Literally, they just create the cash because now they have this new asset that just appeared on their books. So they have value. They can then transition, or they can just pass that money along to Treasury, and then Treasury can, in the Exchange Stabilization Fund, can purchase whatever they want. They could purchase Bitcoin. They could purchase, but it made its way into that act. So the point is that Scott's the kind of guy who understands the plumbing of this system and can figure out clever ways to do things like that.
Yeah, that's interesting. Take me into the mind of maybe a CIO. It's end of Q1, risk assets are getting hammered. It's not just crypto, it's Tesla, it's Palantir, it's Coinbase stock, right? Things are getting hammered. What are CIOs thinking today, specifically around risk assets?
So when you say CIO, and I think a lot of people in this industry talk about, number one, you're talking about an institutional CIO, not a family office CIO, presumably. There are CIOs of hedge funds and asset management firms, and then there's CIOs of pension plans and large endowments and sovereign wealth funds. I think those, when people hope that institutions come to the market, they're hoping that group comes to the market because hedge funds are already here.
They're hoping that the big allocator, the pension, the endowment,
and the sovereign wealth fund, yeah. So those are what we would call, they're institutional investors, but they're really the asset owners. They're the ones, everyone in the world, myself included, is scrambling to hopefully manage some of their money, and some of it they direct themselves as well, of course. So what's going through the mind of those folks right now? What we're seeing, I think that what we'll discover is that over the next year, there are going to be an awful lot of these sovereigns and certain institutions that have started to accumulate. I think if you're a sovereign and you're looking at what the U.S. is going to do right now, it would kind of be foolish to not start taking a position. But there's no reason to really announce that. So I think that we're going to start seeing certain sovereigns invest. When it comes to pensions and endowments,
just on the sovereign side, are these, because we've seen some sovereigns, it's like Bhutan is doing Bitcoin mining. El Salvador, obviously Middle East is pushed pretty strongly. And will we see like Western nations, you mentioned Germany. Like, are we going to see, I guess, like bigger Western nations do this, do you think?
I think so. I think, look, if the U.S. is going to go down this path, and I think that we are, then it puts pressure on everyone who's running one of these to make the decision to either do it or not do it. And if you don't do it and the price goes up, there are consequences. If you do it and the price goes down, there are consequences. And it seems pretty rational that if you see a real pathway for the U.S. to go down this path and U.S. states to go down this path, you should probably acquire some.
Yeah, it feels like the U.S. doing the Bitcoin Strategic Reserve, or whatever the official name for it is actually the equivalent of, remember when Paul Tudor Jones said Bitcoin's the fastest horse in the race? I think it was May 2020. That basically removed all the career risk for hedge fund managers. They said, all right, PTJ does it. I can do it now. And if it goes down, he did it, so it's fine. So it feels like this is the equivalent for on the sovereign side.
Yeah, I think so. I mean, there are 100 sovereign wealth funds in the world, roughly, with $15 trillion of assets. So, just a percent is a lot of money.
Yeah, definitely. What about on the endowments and pensions?
Those are kind of our clients. We do actually work with some sovereigns as well. On the non-crypto side of our business, we work with sovereigns. I'm not going to show the hand of any sovereign when it comes to crypto. I think the journey of the pensions and endowments has been really interesting. So, Jan, as you said, we were an early institution to invest in Bitcoin and ETH, and that was in November of 2020. Regulators forced us to disclose that in December, and I think the market got really excited about that, that was when prices blew through the old 2017 highs, or the 20,000 highs. And I think that it was interesting because part of that narrative was, okay, the institutions are finally coming. And what we didn't see is the institutions actually come. So there was a big run-up in price over 2021. And during that run-up, what you saw is the endowments and the pensions set up digital asset working groups. They called them dogs. And everyone thought there was the most clever name in the world, but they all had the same name. But they really didn't allocate. And so then the market rolled over, and I think they just stepped away. So even the institutions who looked highly likely to commit, and some of them we were working aggressively with, and they were ready to commit, but they just didn't do it in the depths of that bear market. And then this bull market happened really so fast. Kind of post that FTX low, there were plenty of people who thought this market was going to be dead forever, and they just didn't want to touch it. And the Celsius blow up took most of the Canadian pensions just off the board for quite some period of time, because they had made some investments that the local newspapers destroyed them over. And so this bull market has been so quick that now these digital asset working groups are back. We're starting to see signs of allocation, but the real wave of money is not yet here, not at all. I think it's coming, but and this time I think they have done enough work from 21 up now through 25 that we will start seeing these allocations.
Are they going to allocate? I feel like venture. I'm guessing they're not just like going out and buying Bitcoin and ETH and Sol tokens. I'm guessing they're doing it by allocating to funds. Tell me if I'm wrong there. But on the fund side, the industry's been dominated by venture funds. I'd guess 95% of the allocator capital that's come in has gone to the venture funds. Will that continue? Will it be more in the liquid funds? Am I wrong, and they'll just start buying tokens themselves?
I think they will start buying tokens, actually. Interesting. Yeah. I think they'll be the majors, and that's where they'll start. They will also invest in investment funds that focus on crypto. I think we'll see some index investing. There's some very large investors in the world that are looking at defining what their index is that they will measure their own performance by. And so, we've put out the Coin 50 index. And so that, for example, that would be the type of thing that they'd be like, okay, well, now we have a benchmark. These big investors tend to need a benchmark to measure their own performance by. So now that we're seeing pretty credible, or I'd say very credible indices, but indices where you look at and you're like, okay, this is thoughtfully put together. Our index has dodged some of the real catastrophes in this space, for instance. And so institutions can then get comfortable with that, and it would make sense that at least part of their investment would be actually in their benchmark.
Will they allocate to anything beyond Bitcoin, ETH, and Sol?
I don't think it's size. The type of investor that I'm talking about right now, I think they will be late to anything outside of those. Maybe there'll be trace investments. And there may be some investments that they do make because they're in an index. They will have some investments through their venture holdings, but I don't think that they're gonna go down the cap table and be investing in the 15th or the 30th largest market cap. They'll get that pass. I mean, they will have some exposure through some of their managers, but not direct buys. I don't see that.
What is the story these days for the big allocators? So like if Bitcoin is digital gold, that's an easy story to tell, right? I feel like a couple of years ago, you go in there, get into an office, and you're like, Ethereum is like supercomputer, world computer. All these apps are going to get built on top of it. What is the pitch now? What is crypto to these allocators?
Yeah, I think Bitcoin is digital gold for sure. I think I have always held the view that it is not only digital gold, but there is a embedded technology call option in there because it's the most secure network in human history, and people just haven't yet figured out how to build something on top of that. Really, I mean, not at scale. And so I still think that we haven't figured that out, but I hold some hope that we will, and if that were to start to happen, I think Bitcoin is a lot more than digital gold, because at the end of the day, gold is mutable and Bitcoin isn't really. I think Ethereum, this idea of this global computer, and people talked about stuff like that, but they didn't really understand it. I think the way we think about Ethereum is it's going to be what the global financial system is built on top of. There'll be some other protocols as well, but I think Ethereum will be the most important one. And when we speak with investors, that's what they're thinking as well, or at least they don't reject that.
Yeah. Do meme coins and like this whole debacle of whatever's happened in the last couple of months or several months, how much does that hurt our opportunity at this institutional allocation?
It's a fair question. I think it's largely ignored.
Yeah, because they just knew that those silly games, and they're like, yeah, the crypto people are just playing silly games again.
I think that type of activity has largely been tuned out, which I think is a positive, by the way, because I think investors are focused on the technology. I think the fact that the government has made it that the U.S. government has now made it clear that this is going to be part of the financial system. The fact that BlackRock got behind this with the ETFs, and there's been so much flow. I think that the notion that these assets are Ponzi schemes or going to just disappear, I think that that's more or less over at this stage. And so the really frivolous activity, probably some portion of the people in this room are really engaged in that or pay attention to it. I really think institutional investors are probably spending 98% of their time thinking about the portfolio that's not crypto, and with that additional 2%, they don't have the brain space to be thinking about meme coins, really.
Yeah, that's fair. There's a good panel, I think it's coming up next, with Pranav and David Kalk and some other liquid managers. I'm sure they'll be talking about where we're at in the cycle and stuff like that, but where do you think, you said the cycle has happened really quickly. Do you think we're still in the cycle? You think there's no such thing as a 4-year cycle? You think the 4-year cycle is very much intact and we're halfway through? What are your views on that?
Yeah, I'm not a 4-year cycle guy on a forward-looking basis. I think you can look back through time and you can find cycles in many things, and if they persist long enough, agricultural cycles, certain business cycles, then you can look at that and say, that makes sense, and there's a certain cadence to it. I think that there probably is an underpinning to a 4-year cycle in these assets, but due to the nature of the massive change in market cap and the participants coming in, I think it's going to change correlations. I think it's already changed correlations, and I think it'll change the 4-year cycle.
Do you think fundamentals, like token fundamentals, like REV and like quality active address, will we start to value these applications and these chains more on as the institutional crowd comes in? Will they look at this on a fundamentals basis, or will the industry just stay very narratives driven for a while?
I suspect it's going to be narratives driven for a while. Look, there are just a lot of people that need to buy these assets, unless they're just going to dismiss them outright, they need to get a position on, and that's going to be this next wave is going to be driven by investment committees, at least from an institutional perspective. I think it's going to be driven by investment committees who, it sounds silly, but who just say, okay, well, the U.S. is going to set up a reserve and there are going to be other sovereigns invested, and it looks like a lot of things are starting to be built on Ethereum, and Wall Street seems to be more engaged. And I keep hearing more about tokenization, and oh my God, we actually own nothing. So nothing is the wrong number, and so that doesn't sound super fundamental. I mean, like at a very high level macro argument, I think it is fundamental, but it's not the kind of discrete.
Not building a discounted cash flow for radium or something like.
I think what they'll do is they'll have their junior analysts try to build some of that stuff out, and if they come back with the wrong answer, be like, that's just the wrong answer. Like we need better.
Give me a number that shows ETH at 10,000.
Because we all know that we're gonna have to buy some of this stuff, so let's just get it on.
Yeah, sure. Maybe as we wrap up. Is there anything, just in your position at One River and at Coinbase Asset Management, you speak with more allocators and institutions than probably most of us in this room. Anything that feels very obvious to you right now that maybe to many people in this room we're not seeing yet?
I think the lack of understanding for how impactful rebuilding the financial system on crypto rails is, I think that's really underappreciated. So, when we entered this space, I think the things that were really underappreciated by otherwise not very knowledgeable investors were they thought that you couldn't store these assets safely. They thought they were overwhelmingly used for criminal activity. And they thought that because Bitcoin could just be created and copied, that there could be an infinite number of Bitcoin protocols out there, and therefore there would be no value that would ultimately accrue to any one or group. Those were, I think, the big misconceptions. Now I think people are being forced to recognize that these assets are here to stay, and they feel horribly about the fact that they looked into them in 2021 and then they didn't buy in the bear market, and there's major brain damage that prices are as high as they are right now. And I think yet what they fail to appreciate is, 5 years from now, I think most of Wall Street will be well on its way to trading everything in a tokenized way. And that there will be a lot of value that accrues to the technologies and the entrepreneurs that figure out how to provide great infrastructure, great services, and I don't think that they fully appreciate that.
Yeah. Eric Peters, everybody. Thank you very much.
Thank you, Jason.
Thank you, Jason and Eric. Definitely sounds like the game theory of Bitcoin has been set into motion. So our last discussion of the evening is going to be on outperforming in liquid token markets. So please help me welcome to the stage Raghav Chopra, Pranav Kanade, Ben Foreman, Ryan Watkins, and David Cork. Let's give it up.
Good afternoon, everyone. Equity markets are closed, but the digital asset markets are open. I'm Raghav Chopra. I'm co-founder, managing partner at Tefra Digital. We're a digital asset investment firm, and we also focus on liquid markets, and it's a pleasure to have some great peers here. And so let's kick it off with a quick introduction. So Pranav, David, Ben, Ryan, tell us about your firm, and just start with what differentiates your strategy.
Work at a firm called VanEck, large asset manager. I run our liquid strategy. And a punchline, what makes us probably different is we can do both equities as well as tokens. We can go where the opportunity is, and we're a long directional strategy.
My name is David Kalk. I started Reflexive Capital. Initially, this business was run inside of a large macro hedge fund, so the investment team comes from a macro background. I'd say this space, to me, this space is almost never in equilibrium. You have these violently different regimes, this boom-bust cycle in crypto. And so I see a lot of people doing the same thing the whole time despite that fact. And so I think there's an opportunity to adjust the portfolio to one that's consistent with the regime in a way that compounds money differently than strategies historically have.
Ben Foreman, a founder of ParaFi Capital. We're a multi-strategy investment firm focused broadly on crypto capital markets. What differentiates us is really our scope. So we invest in both tokens and equity, directional, non-directional strategies, and are early in both late-stage markets. We manage about $1.5 billion, have been around for 7 years, and our team really has a mix of both traditional finance backgrounds as well as kind of deeply technical engineering backgrounds.
Cool. Ryan Watkins, co-founder of Synchrony Capital, founded in 2022. We're a long bias hedge fund. What differentiates us is we are singularly focused on liquid token investing, and we run very concentrated, and we're very fundamentally driven.
Great. So we're going to launch into some real specifics. But to start, since each of you have some pretty good perspective on how markets have evolved, how has liquid token investing changed over the last 3 to 5 years, and what does it look like for the next 3 years? So at the broadest level, what's different and how's it going to evolve?
Ben, you've been around the longest. Why don't you go first?
Yeah, we're at like a pretty interesting point in the market cycle. Actually, we kind of say it's the best of times and the worst of times. Right now, like we've seen this, in some ways it's the best of times. Why? Because we've seen this surge of just institutional interest in the space, right? The Bitcoin ETFs, most successful ETF launch in history. Tokenization on chain, you have BlackRock that's tokenizing treasuries, right? You have stablecoin volume at a very meaningful global scale used in payments. You had Stripe's acquisition of Bridge. There's a lot to be excited about, and I think a lot of that excitement is spilling over into liquid token markets. So in some ways, it's the best of times. In other ways, it's a very tough time to invest in token capital markets. I think fundamentally, there are too many tokens. There are divergent incentives and governance issues that are plaguing the space. There's a big mismatch between supply and demand. The institutional bid is really not coming outside of the top 10 coins. To the previous panel with Eric Peters, he touched on this. And in prior cycles, you look at 2017 bull market, 2021 bull market, there was this idea of this ubiquitous bid across all alts. Alt season was what it was referred to, and Bitcoin would trade with a beta of 1, and Ethereum would be up 1.5x, and alts would be up anywhere from 2 to 5x. And everything was kind of one big macro bet. But what we're seeing today is just much, much more return dispersion. And as a token investor, I think what it really comes down to is you need to untangle complexity to identify alpha in the market. And not to kind of nerd out for a second, but I think the return dispersion is more leptokurtic. So there's a fat right tail, and then a fat left tail, and then a bunch of things that won't make money on a forward-looking basis. So it's a tougher market. There's more of a flight to quality, more dispersion. Things like buybacks matter. We can probably talk about that later. But the market, and this whole process, I think, is a healthy one. Because if you think about digital assets, they've been around for 15 years. The asset class overall has been in price discovery. Like, are these currencies? Are these commodities? Are these capital assets? The market didn't really know how to value them. And now the market's getting smarter. So I think this is a healthy process. And I think we're just going to be in a much more of an alpha-driven market versus a beta-driven one.
Yeah, so I think very good points. If you had a fund 5, 6, or 7 years ago, it almost didn't matter. You just got to be early, and everything did go up, and so it worked out. You could absorb whatever volatility came from the market because everything would just go up 1,000,000% and then down 90%, and that worked out okay. But not the first time in the history of capital markets that there's a certain set of performance that money chases in a way that satiates that performance and then some. And the biggest problem, even for being a liquid token investor at this point, is there's just way too much money chasing very few venture opportunities. And as a result of that, these tokens, when they first come to market, are just priced at a price where nobody wants to touch them. And so no longer can you perform in the same way by just having access and being early in the liquid market. So yeah, I think the next few years, looking for new ways to source edge in this market. I do think we have a set of incumbents who are mostly investors, or have succeeded based on their venture capital prowess. I believe very strongly that a venture capital investor and a trader are different skill sets and almost the opposite skill set. And based on the fact that most tokens are being managed by VCs, there's an opportunity for I think traders to come in and source edge and outperform by being risk managers, by being professionals. I think there will be more active management required, more token picking as well, because not everything will go up. But that does support new sources of alpha from here.
We were all hanging out before coming here, and I guess I was like the most bearish person in this panel. So the altcoin market is 560 billion, give or take. It's like take out Bitcoin, Ethereum, and stablecoins. That's where you kind of end up. I think that number is going to go a lot lower between now and like the next 18 months. Many of the things you've talked about is probably the reasons why, but generally, the industry is kind of overbuilt, quote unquote, infrastructure by using a lot of buzzwords, and most of that stuff is commoditized. And on the other side of like stablecoin legislation, I think you'll see a whole range of companies adopt, let's just say, stables and the things around stables like tokenized products and all these things. But the winners of that will be the actual companies that adopt it. And it's not necessarily going to be the things under the hood. Because again, the things under the hood, in my opinion, are generally commoditized and probably might not even be used. So most of that market cap is useless and will disappear. So the question then is, like, if you have that view, how do you generate alpha in that period of time between now and, let's just say, the future state, 18 months from now? And to us, much of that will come in the public equity markets. Generally, we were early to find Coinbase and Robinhood as some winners in the last couple of years. Similarly, we're spending a lot of time today looking at internet companies, e-commerce businesses, just digital native businesses that have interchange fees as their big cost line item. And to the extent they can leverage stablecoins in the future, how does that cost structure change? And what does that mean for multiple expansion in these businesses? So if I looked at my portfolio 18 months ago, a lot of that was in tokens. If I look at my portfolio going forward, I think a lot of that will be in public equities. And that's where I think most of the returns will come from.
Yeah, maybe just a couple final points, because I think we definitely talked about this before and don't want to be repetitive. I think we're starting to see a material change in the underlying fundamentals of the projects. So we go back to 2017, and most of the market was driven off ideas. So the ICO boom was all about people releasing white papers, and white papers are really just broad ideas for what this technology could potentially achieve. But it was all vaporware. And you fast forward to 2021, and the expectation heading into that cycle was that this was all vaporware. So all we needed to do to get the ground running again was just to show that this works. And that's what we did. We invented DeFi, NFTs, and all the things that people got excited about in that 2020 to 2021 cycle. But the problem, and I think this is still a problem today, is that so much of that growth is very cyclical. So you look at all of these different financial protocols, whether they be exchanges, lenders, it is very cyclical growth that is dependent on flows coming into the asset class and prices going up. So it creates this scenario where whenever prices are down, the fundamentals actually start to deteriorate. And that is a fundamental structural issue that the asset class has today. But how does this look going forward? Because that was also one of the points we were making in this. And I think we're starting to get to a point, and this will be a transition period, it won't happen overnight, where we will, because we have more regulatory clarity, because we have more institutional participation, because we have enterprises starting to more seriously enter the game and really use these systems. We talk about Stripe acquiring Bridge and starting to make them real push into stablecoins. You talk about BlackRock tokenizing assets on blockchains. Like, these are actual, not just experiments, but people really making bets on this technology reshaping the financial system. Now we can get to a point where fundamentally we're not just betting on cyclical growth, we're betting on compounding growth. And that is a much more compelling story that is a much more sustainable story. And I think that's how you get to get people to underwrite this asset class on a long-term horizon and not just as this cyclical boom-bust sector where you have to time the markets and get in and get out.
Yeah, great segue. So there's been a lot of cyclicality, but the question is what's structural? And we've talked about the outsized role of macro in the investment process, but on a fundamental basis, in each of your investing activities, have the fundamentals actually led to an idiosyncratic return as far as token dispersion and outcomes? And if it hasn't, then when do you think that'll happen? And are there key metrics, whether it's just a few, whether it's TVL or others that you can pin down that are the true drivers of value accrual? So where do we stand on that?
Maybe I'll start by saying we should replace the word cyclical with speculative, because that's really what it is.
Hyper-cyclical.
Right? Well, like speculative, like people's desire to gamble. Because I think it's most of like when people quote fee metrics and price to earnings on tokens and things like that, it's really like people's underlying driver is really like people speculating on different tokens with leverage. So on the other side of it is like I think we've been spending a lot of time on our side talking to folks servicing fintechs who are essentially facilitating cross-border B2B transactions using stablecoins. And I think that's a non-speculative source of demand and activity and fees, and ultimately that's going to trickle down to a variety of blockchain projects. It's still not very clear who exactly. We have some views on who those could be, but I think we're still in the early sort of discovery stage of that. And I think ultimately that will get you to the point where fundamentals will drive performance for tokens, but my personal view is we're a little far away from that.
Yeah, I think I would argue that fundamentals do shape the outcomes, but it depends on what sectors of the crypto economy you're looking at. So there are sectors that are more mature and further along in their life cycle. I think DeFi is one of them. And then there's way more speculative early stage sectors like, say, AI. And if you're looking at AI and none of these projects have any meaningful economic impact, then yes, of course, fundamentals don't matter. It's just all about narrative, storytelling, flows, and that's pretty much what drives the returns. And if you're looking at DeFi, I would argue fundamentals do matter. And yes, there is a debate on how much of the growth that these protocols experience. Is it the speculative, is it driven by speculation, is it cyclical, or is it actually something that's more sustainable and compounding? But it does actually shape the outcomes. And I think a good example of this is Solana from 2023 until basically end of last year, where it did a public, like a liquid 20x from the bottom and then maybe 10x from where most people could buy. What caused that run, and why was that so outsized compared to all the other smart contract platforms? It's because it got the usage, right? You could actually pull up a chart and see that Solana was earning way more fees than every other blockchain, including Ethereum. And there's a wide variety of metrics you can use to make that call. So I'd argue that fundamentals definitely do matter, but you have to take the fundamentals with a grain of salt, given all of the kind of the flaws that almost like the revenue quality of many of these projects is kind of low.
Yeah, just to add to that, I mean, I think people often pose the question, like, do fundamentals matter? As if it's like a binary question, like a on-off switch on a light switch. But really, it's more of a light switch on a dimmer, right? Like, how much do fundamentals matter? And I think the reality is they're mattering more and more. I think if you look at decentralized finance, I mean, there's a non-trivial amount. We estimate kind of like $2 to $4 billion of on-chain earnings. These are people, users, doing things on-chain, and they're willing to pay protocols, which are effectively these kind of toll booths on the internet, a fee for engaging in either trading, borrowing, lending, or buying insurance on-chain, or any sort of these fundamental transactions. So that's real GDP that's flowing through blockchains. And I think at the end of the day, like one of the challenges with fundamentals is just there are too many tokens, and it's very difficult for retail who really has been the marginal buyer, to understand which tokens have fundamentals and which ones do not, because it requires like parsing on-chain data, right? There are no 10Ks and 10Qs in this market. There are no gap financials. And so it's very difficult to determine what really fundamentals are. Like, is it users? Is it volume? Is it earnings? And so as the data in the space gets better, and also as protocols that are earning these fees actually like start buying back their own token, I think fundamentals will matter more and more. It's been a long journey, but I do believe that markets over long periods of time bend towards fundamentals. It just has to be the thing that ultimately drives market prices.
You know, one of the tricky things, and okay, here's the macro guy coming in to share a macro view, is it like, it feels like it depends on the regime. So, you know, I could see this regime, like the fundamentals which guided me over the last 12 months, it's like those could totally flip and multiply by -1 for the next 12 months. And I see kind of fundamental analysis struggling with, things tend to work episodically in a way that make it hard to fixate on any set of fundamentals as long-term drivers of performance. And so when we've done analysis, okay, to this, you know, should we look at this like a PE ratio? You know, in a bull market, like, again, do the opposite because people are trying to 10x their money and not own something that has free cash flow yield or whatever. And so that's, it makes it very difficult to answer that question. And I think going back to the macro just reflects the role that capital inflows. I mean, the space is just never in equilibrium. If capital is flowing into the space, a certain set of things work. If it's not, a certain set of things, or, you know, very few things actually work. So as the core of our process, we like to start with, do we see a feedback loop of price and capital flows and fundamentals reinforcing each other? If we see that, then we'll play the fundamental game. If not, you got to run in the other direction.
Yeah, good. I mean, the complexity is like no other, but that also puts the fun in fundamentals. Over the last couple panels, whether it's regulatory or institutional flows, there's just a slew of forces, and there's been an obvious sea change. The question here is, since we're talking about outperforming, what do you think is underappreciated as a bullish force for the liquid token markets, and what's underappreciated as a potential bearish force in your outlook? So,
Mr. Bear,
based on where we are, what are people missing that frames your view?
So I'll give you the bull case, I guess, since I was bearish for the last couple times. I think I came into the space because I believed tokenized equities were going to be a thing one day. Just businesses could tokenize this asset that's their equity, and they can do useful things with it beyond just represent kind of this ownership thing. And that's happening. You know, we're tracking that very closely. The general thesis we have there is, if you go on RWA.xyz, you'll see that 150 million people in the world own stablecoins. That number could be exaggerated, give or take. Let's just say that's the number. 5 billion people on the planet have an internet connection, so 150 of 500 is a decent number to start with. But as that number grows and more folks across emerging markets, other places outside the United States, get stablecoins in their wallets, they're going to want to own productive assets with it. And I think that productive asset is going to be tokenized equities. It's great for the issuer, you know. Every issuer is going to have their thing they want to do for their business with a tokenized equity, and it's great for the purchaser because they're getting a productive asset. So to the extent that story plays out faster than I expect, that's your bull case, because that's going to create a very specific winners in DeFi. That's going to create a very specific set of winners on L1s. You know, that's going to create some market structure based on where all that activity takes place. So I guess I don't know if that answers what you were asking.
But why should we be so bearish?
What's that?
Why should we be so bearish?
Because I think it's going to take longer than the next 6 months.
Yeah, that's a long time. To build off of the last thing I was saying, you know, so what is like macro being applied to crypto to mean? Does that mean like you're looking at new home sales and buying Bitcoin? You know, it's more about using a macro toolkit to understand this closed system, and is money coming in and out? Is credit coming in and out? What is the cycle pattern that we're seeing? And I guess the most bullish thing I can say around this current moment in crypto is we've had some episodic inflows into Bitcoin, which has been tremendous. But the rest of this space has not seen an inflow in 2.5 years. And so the question is, like, is that going to happen? Because I think if it does, we should be very open-minded to what that will feel like. There's a lot of people sitting here in March of 2025 making terminal conclusions about what this cycle is. There's too many tokens. We're never going to have an alt season like 2021. We don't really know what it's going to feel like if money flows in. And the pattern which I am super fixated on with respect to this process is this self-reinforcing relationship, and Pranav's heard this about 30 times from me, but this concept of market reflexivity is just so important. It explains everything in this market because people are trying to identify network effects, and network effects are often people speculating and chasing price. And so you get this dynamic where price goes up, the fundamentals in the space get much better, and then capital flows. So then price goes even higher, the fundamentals get better, and capital flows. So that's a feedback loop where we haven't had that in motion yet. You can say it's not going to happen, but the underappreciated bullish potential is the fact that that could get set in motion. And then I think all bets are off, and we should be excited about a whole new setup.
I've heard the reflexivity pitch.
You have heard it many times.
But I'll give you a different feedback loop, which is we start with money needs to flow in for the thing to kick off, right? So then I ask you, why is money going to flow into this stuff? Because the thing I notice is like until we see real use cases where people outside this room are touching and feeling products that are leveraging some things on chain, I have a hard time seeing a lot of money flowing in, especially enough to offset all the vesting and all the stuff that's happening outside. As I talk to folks outside the crypto world from just purely from this asset manager perspective, the thing I notice is like the most common question is like, I see all these positive regulatory headlines, but like, I don't touch and feel this stuff. Why am I supposed to care? Right? Where's my chat GPT? And I think it will happen. I think it's going to be tokenized equities. It's just a question of timing.
Sorry. Yeah, I would never want to comment on my actual fundraising process, but I know there are allocators out there, and I hear what they're saying. And I think the most important thing is they're still engaged in this asset class. And I think basically there's just all the kindling is there for any catalyst, which yes, it's impossible to see exactly what it is, and maybe it'll take 6 months for a chase to build. And I do think this regulatory catalyst was significant enough to activate people in new ways. They just were not going to come in December. They were not going to come in January. These dog groups, as Eric Peter mentioned, these are 6 to 9 month timelines. They have calendars to them. They're having their first quarter committees, and they figure out their managers over the summer, and then maybe in the fall they're ready. So, yeah, I think if you force me to tell you the catalyst of what it's going to be, I would say I don't have one, and maybe that's not going to happen. But I think this stuff can build in a way that it's very hard to see now, but we shouldn't sell it short.
For Ben and Ryan, so on this, right, on this unlock question, underappreciated bullish or bearish forces, but also is stablecoin legislation and market structure legislation a real unlock for the liquid token markets, or will it come and go?
Okay, so there's a lot to unpack. So I think like we talked about cyclical, but I think secular like demand for block space is really like ultimately the North Star. And if our industry created nothing more than stablecoins, that would be an enormous TAM. Like the market for moving dollars on the internet, on blockchains, is absolutely staggering. And actually, if you think about stablecoins today, they're a $200 billion market, but 70 to 80% of every transaction on a blockchain involves movement of a stablecoin. So if people ask you, what are people using blockchains for today? It's really moving dollars. And I think what you'll see in the coming years, and this is agnostic to wherever token prices are, this is a secular trend. What you'll see is stablecoin supply will go from 200 billion to 2 trillion in the next 12 to 24 months. You'll see sending and receiving wallets of stablecoins go from 25 million monthly active senders and receivers today. I think that number will also grow meaningfully. And both of those numbers, like senders and receivers and stablecoin volume, have both compounded at 40 to 60% growth rate over the past 5 years, agnostic of a bull or a bear market. And I think the issue that allocators have is they group crypto with AI. Fundamentally, I believe blockchains are more of a B2B technology. I don't believe that consumers will interact directly with blockchains. I think that's the wrong framework. There's no chat GPT of crypto. Like, I'm sure plenty of people disagree with me. I believe that the 90,000 financial institutions in the world, the banks, the fintech companies, will be the consumers of blockchains and will use them to move money. And I don't think that requires like anything else getting built in this industry for it to be very, very valuable. So that's my take on that. And then look, I think that with stablecoins growing, DeFi is going to grow too. because it's only natural if you're moving dollars on a blockchain, you're going to want to do things with those dollars. And I think the biggest underrated force today or going forward will be token buybacks. The value of the stock market is the net present value of all the earnings of the companies that are listed. I think the net present, the value of altcoin markets are the net present value of all the on-chain earnings that they generate, primarily derived from these stablecoin earnings. That number is growing. I think right now it's trading at a very low multiple relative to growth. And you have the supply and demand dynamic. So again, like I think buybacks will be the prevailing force. But yeah, I think everything we need is actually been built today, and anything extra is like optionality in terms of like new use cases and AI. Like, I think people get excited about that, but stable coins, real world assets, Bitcoin, just those three things are absolutely huge.
Yeah, so I'll share a couple more points on the productive assets points, and then maybe I'll give a bearish take on this as well. I think on the productive asset points, what do blockchains do at their core? They enable you to create assets, to move them around, and then to enforce contracts between them. And this isn't meant to be reductive because, contracts are the basis of many institutions. There's almost like a theory of institutions that they're a nexus of contracts. So I think it's just a core building block that you can use to build many different things. What happens when you put this power into the hands of not only institutions, but into the hands of individuals? Well, in some cases, you get really great things like stablecoins. People put dollars on blockchains, and all of a sudden you can move it around the world super cheaply, and it's fast, and it's efficient, and everyone in the world can access it. But what people also do when you can create an asset on a blockchain for 1 cent, and then you can have anyone who will trade it, is they create dog coins and cat coins and all these ridiculous things, right? And that is what has happened. And you look at even like Solana, which was like the leading blockchain by usage over the past year. The top exchange on Solana, it was like Radium. About 70% of the volumes were meme coins at the peak. I mean, this is what people were doing here. So, what is the issue? The issue is not that these assets exist. It's just that there aren't higher quality assets that have been uploaded to blockchain so far. So when we talk about this regulatory unlock, this is the ability to take, you look at like in Solana right now, there's maybe around like tens of billions of dollars of assets that are on Solana. Ethereum, maybe like higher, maybe like higher tens of billions, maybe around $100 billion of assets that are uploaded on Ethereum. When you talk about uploading the rest of the financial system onto blockchain rails, you're talking about like tens of trillions of dollars that are going to be uploaded onto blockchains. And you're no longer going to have people that are just buying and creating and selling a bunch of nonsense. It's now someone is funding an entrepreneur in an emerging market to go build a startup, right? It's now people are financing a government to go and, fund some program. I mean, this is how you actually unlock the productive crypto economy. And I think that the regulatory constraint being lifted is actually like a huge underappreciated unlock and actually getting increased utility of the blockchain. So it's not just like this very circular economy where everyone here is just questioning, what is this used for? And then on the bearish side, because I do think that I want to mention this as well, we talk about like almost a common theme among all the bull cases is that we have this regulatory unlock and then therefore we can go and do all these cool things with blockchains. Well, one of the issues that I've seen recently is that it seems like the industry is starting to become more politicized. And the risk that you have when you have an industry that a technology that's starting to be politicized is that, well, administrations change, like governments change. If we get a change in Congress, if we get a change in the administration in the next 2 to 4 years, and the technology is still a political lightning rod, then a lot of this can get unwound. And we'll be back at square one where we're fighting against another really challenging SEC. So that's a risk I do think about in the back of my head.
Good. Well, we have a ton of other topics, but it's lightning round time. So whatever the safe harbors will allow, since you're immersed in the space and we want to give real money value to our audience.
Not financial advice is what you mean, right?
Never heard of that. But we're going to do a packaged last question. So the question really is, what do you think crypto market cap in trillions ends the year? What do you think Bitcoin dominance is? And your best sector theme?
I'll let Brian go first.
Yeah, so I think we end the year probably around like the same more or less market cap. I think this will be a flat year. And then as far as, was it sector theme?
Sector theme and Bitcoin dominance.
And Bitcoin dominance. I think Bitcoin dominance also ends the year around the same. And I know it's kind of a boring answer. And then as far as the sector theme that I think is most exciting, it's DeFi. And basically for the reasons we just discussed, which I won't repeat.
So I would say 3.5 trillion, so maybe 20% growth from where we are today. Bitcoin dominance, I think, grows this year. So we're at roughly 58, 60% on Bitcoin dominance at the moment. So I think that maybe grows modestly to say 60, 62%. And then I'm going to also, not to be trite, but I'll go with DeFi as well.
Okay, I'll go 70% probability of 4 trillion market cap, 50% Bitcoin dominance. So that's Bitcoin basically right here and an altcoin cycle materializing. And 30% chance of 1 trillion. That's pretty good convexity though.
So the EV ends up where you are, kind of.
Yeah, but not in altcoins.
So net
in
bullish.
Bitcoin. Okay. Bitcoin, the skew is bad. The altcoin skew is good.
So if you include stablecoins, or do you not include stablecoins in dominance?
I think we've been including stablecoins.
We've been
including.
The big issue
Okay.
with dominance is Ethereum.
Right. So I would say
Dominance
Bitcoin
higher,
dominance
just
is
Ethereum lower.
lower, marginally, because of stables. I think crypto market cap is, well, most likely lower, but unless like Scott Besson figures out how to buy more Bitcoin, being budget neutral. So that's a kind of like call option on Bitcoin. So if that happens, I think all bets are off in some ways. And the sector that's most interesting is, again, like public companies that have nothing to do with crypto that can leverage stables.
Great roundup. Thank you guys. And thanks Blockworks. Really great discussion and good debate. Thank you all.
Okay, thank you to our panelists. That concludes the last session of the evening. Thank you everybody for coming. This was the end of Blockworks Day 1. Something that you may like, this happy hour already started upstairs, so please feel free to go up, network, and grab your drinks. Thank you again.